Good evening. Should I start?
Yeah, मैं
Good
continue.
evening, everyone. Good evening, everyone. I see Ankita Chok, a practicing CA from Amritsar, wholeheartedly welcome you all on behalf of Committee on Financial Market and Investor Protection of Institute of Chartered Accountant of India, hoping our audience in pink state of health. So the member, today's session is about investment options or avenues in India under the domestic fund regime of alternate investment funds that would include tax and regulatory implications, to be delivered by our esteemed speaker, C.A. Shilendra S. Sharma. All attendees are eligible to claim 3 unstructured CPRs at the conclusion of today's program. The Committee on Financial Markets and Investor Protection, CFMIP, provides suggestions on various bills, notifications, circulars, and other documents related to financial markets to the government and regulators. Besides this, the committee regularly interacts with MCA, RBI, SEBI, Insurance Regulatory and Development Authority, Forward Market Commission, and stock exchanges on the issues related to financial markets, role of CAs, and investor protection. To create awareness among the public at large and to ensure investor protection, the committee conducts investor awareness programs through various resource persons and the program organizing units of Institute of Chartered Accountants of India, that is branch and regional councils, under the aegis of Investor Education and Protection Fund Authority of Ministry of Corporate Affairs. Proceeding further, let me quickly invite our most respected chartered accountant of our fraternity and the chairman of this committee, C.A. Charan Jot Singh Nanda. Over to you, sir. I guess he has not joined yet. So let's invite our speaker for the evening, our esteemed speaker, C.A. Shilendra S. Sharma. He is an international tax professional with nearly 15 years of experience in large accounting firms in India and Singapore, with an in-depth know-how in advising various multinationals on mergers and acquisition restructuring, IPO, IP planning, fundraising, FDI, ODI, tax litigations, and arbitrage, etc. He has assisted diverse clients across sectors like financial services, insurance, banking, and financial institutions, fund industry, consumer durables, startups and incubators, healthcare, etc., and so on. The list goes on and on. Thank you so much, sir, for coming here and coming here to deliver such an informative session. The virtual dice is all yours, sir.
Thank you so much, Ankita, for the brief introduction. At the outset, I'd like to thank the committee of CFMIP, especially Nanda sir, to grant me an opportunity and address the esteemed audience crowd of the ICI Northern region, particularly. And this again gives me immense pleasure, especially when we are looking at India at the forefront of growth path, being the leader, especially in terms of the GDP count, which has been, announced by RBI and the government of India as well from time to time. Good evening, everyone, and thank you all for joining in, especially on a Saturday evening when particularly most of us are taking a break from the hectic schedule of a entire week. Grappling with a lot of compliance calendars, integrating with regulators and so on and so forth, and really taking time out to understand what this particular concept is all about. Let me draw a little bit of analogy as to why alternative investment fund regime has really picked up in a few years now, especially when you look at the last budget. If I were to draw a corollary, you already have seen some of the changes in the budget 2023, like say, for example, you've got market-linked debentures, you probably have mutual funds, especially on the fixed income side, where there have been certain adverse tax provisions, and which really brings in the proposition of an AIF into picture, though it may be slightly on the riskier side, but it helps investors to create wealth, though with a little riskier proposition. So as we move along, I would try and use these terminologies, especially which have been used in the wealth industry. And particularly so, this session is not about wealth, but fortunately it is for my professional friends, colleagues, and seniors especially, who are completely untouched with this particular subject at this point of time. And the kind of avenues that are available for professionals like us to practice in this particular arena, be it on the be it on the accounting side, be it on the tax side, be it on the regulatory side, be it on the corporate governance, and especially where Nanda sir leads the pack when it comes to investor protection. Thank you, sir, for having me here over this weekend.
Always, Sharendra ji. I am truly honored to be amongst you all and very happy that you are here for a full session, putting in right perspective how investment avenues can be made better. Ladies and gentlemen, I would like to tell you very candidly that we all have to work in the direction of creating value and worth through investment. How we add value by investments, how we create our capital, that becomes very, very important, rather immensely important. And people like Mr. Sharendra Sharma, who have led their life into this, they can guide you how you can work in a risk-free environment. The environment is to identify something. See, there are two basic aspects of creating wealth. Number one, you identify a stock, then identify your risk appetite, and then have a target and a stop loss. You have to identify whether you are a speculator, whether you are a day trader, whether you are a short-term trader, whether you are a long-term investor, and then make investments. And second important thing, to understand when to sell, when to average. You can't go on a notion which you always carry. Rather, you have to take a call on each and everything. I'm thankful to CA Shalendra Sharma who has come here. Mr. Sharma, I listened to some of your words and they were really exponential. We have to guide our membership how they could go ahead and create value and worth. Over to Mr. Sharma for his
delivery. Sure, sir. Thank you very much.
And I'm sorry I am a bit late because I'm in Mumbai. We have a program going on, guidance of forensic standards. And I was chairing that, but still it was very important to come and speak to you all. I thank you all and I would withdraw. Let us see how Mr. Sharma performs, and any questions you can take from Mr. Sharma. Is the master of the subject and he will ensure that he puts at rest all the doubts that may have crept during the entire course of the discussion and otherwise also. Thank you. Thank you so much.
Thank you for your kind words. Thank you so much, sir. So with this, particularly just wanted to also share as to, how India in the financial services sector is playing a very key role across the globe. And when you look at news around you, be it the Western countries, especially the kind of news that you are receiving in from the US on the banking side, I think India remains extremely poised to grow at a larger and a snail pace with sustainable growth. So that's where we are, though we may always crib that we are overly regulated at times. But definitely, it is for our own interest and protection. And definitely for professionals like us to keep us going on and on over a period of year, especially when you look at the kind of practice that the AIF industry has to offer, and which of late has been focused and led by some of the large key players. And this is where, I had a discussion with Nanda sir, particularly to grant my professional friends an opportunity to enter and penetrate this particular space, understand the nuances, and then probably make a career out of it. So with these kind words, what I've done is, this is a full-blown session. Try to keep it crisp, but at the same time, I've really made a concerted effort to bring in each and every concept, complex ones, in a simplified manner. and which is where you will be in a state to, go ahead, disseminate it, go through these regulations, and then probably, start creating a practice out of it. So that's an effort that I've done. Let me now just walk you through, especially on the technical session. And what I've done is try to create this agenda, what we will be discussing today. By and large, the topic remains extremely heavy, complex, but just feel free, relax, and let me just walk you through in terms of what are the nuances of this particular concept, how does it work, how does it operate, what are the tax attributes related to this, and how is it, as a professional, we can play a key and a vital role in this particular industry. To begin with, this is part A of the session, and just try to break it up into two parts. Especially, we might need a clinical break, and therefore try to make it in parts. So to start with, I'll just walk you through in terms of the what AIF regulation offers, what is a pooling vehicle, try and talk about the working aspects as far as the AIF structure is concerned, followed by certain operational and prudential guidelines, how foreign investors are playing a key role as far as the domestic fund industry is concerned in India. And believe me or not, it's been like just last year we completed 10 years of this industry. It all started off with a VCF regulation way back in 2012. And in 2022, we see this industry at over 6 lakh crores. So that's the kind of magnitude and growth with which this industry is moving ahead with. Followed by the foreign investment framework in India, I'll talk about the key taxability of how AIF industry has panned out across categories for the investors, for the funds, trying to touch upon certain sensitive issues as well. And then finally, under the tax regime as well, how, especially on the global front, when we see a lot of fund managers, especially, operating these FIIs, staying outside of India. So what are the key opportunities as well as SOPs that have been granted by the Indian government to repatriate them back here in India? And what are the tax relaxations thereof? So that's on part 1 or part A that I will be briefly discussing all about, right? Happy to keep it interactive, though, I'm mindful of everyone's time. I would want to, start on time and then probably finish on time as well. But we'll try and keep a window available for Q&A session as well, right? Moving ahead, just a framework in terms of why an AIF has become suddenly extreme or popular. And as I mentioned earlier, it is predominantly in terms of the government policies, be it on the tax front, be it on the regulatory side. When we see there have been a lot of interest as far as the retail participation is concerned on the mutual fund segment. But simultaneously, as India grows and keep on, consistently growing at a much faster pace than expected, you also see a lot of billionaires coming out from India. And these billionaires or millionaires would want to especially look at certain risky products as well, and not necessarily just, investing or looking at run-of-the-mill ideas, be it on the securities like fixed income, stocks, mutual funds, and so on and so forth. So now these informed investors who have made enough money would want to look at structured products, would want to look at private funds, which is extremely popular globally. And what are they is nothing but caricatured as an AIF or an alternative investment fund. What do they have to offer? They offer high growth, offer diversification of your portfolio, not just in terms of equities, but a couple of other asset classes as well. Sometimes they can be low on volatility, especially when you look at debt funds. They offer you fixed income product with least amount of volatility. But at the same time, the kind of investment avenues that they are into, I think they have a potential of granting, high growth returns. Of course, it comes with a risk parameter. Compounding strategies, definitely, it's more or less a replication of what we look at a mutual fund industry. So it definitely thrives on a compounding strategy. And as I mentioned, we all started off with a base minimum VCF regulation, which was close to 50,000 crores in 2012. That has exponentially grown to a 6 lakh crore industry at this point of time. And then this is followed by multi-class asset opportunity, which does not have any barrier to make investment. So it ranges from equities, fixed income products, structured product, and so on and so forth. So the list goes on and on. This is the domestic investment vehicle, and particularly this is how the industry looks like. So since inception, the structured investment products have been by and large bifurcated into AIF, which is alternative investment funds. You've got REITs, you've got InvITs, and business trusts per se. These are all private in nature, except for REITs and InvITs, which mandatorily under the SEBI regulation have been permitted to go ahead and list themselves within a prescribed time period. Fortunately, AIF industry remains within the unlisted or the private space, while they have an option to be listed post their final closing has been completed. We haven't seen any of the funds which have been listed, especially on the AIF side yet. When you look at on the right hand side, and these are mind you data as on December 2022, you'll be stunned to see the kind of CAGR growth that has been developed by this industry, which is growing at a pace of more than 100%. And across categories, when you look at the focus as far as the industry is concerned, you would typically see the investment more as far as the category 2 is concerned. That's more on the private equity side, and which is growing phenomenally well. When you look at Nikas of the world, which have been invested by some of the institutions, they've made more than 1,000 times returns. So that's where the AIF category 2 side remains extremely buoyant in terms of be it fixed income, be it on the equity side, and so on and so forth. And as we move along, you'll also see how the regulators are also upgrading themselves, trying to bring in global best practices within this particular industry. So when you would want to target a stressed assets investment, they have categorically introduced the concept of special situation funds. And as we move along, I'll try and talk a little bit deeper in terms of what these kind of funds are all about, right? So category 2 remains extremely interested, penetrated, and excited as far as these investment options are concerned. So December 22 data talks about close to 2,000 crores of capital commitment, particularly in this particular AIF industry. And then you've got various datas in terms of investments, fundraised, and so on and so forth. So till now, if I were to look at a cumulative data of December 22, then particularly we look at a phenomenal growth of 6,413 INR billion, which has been committed per se. And of course, it's in phases. So you see, fund being raised and then investments being made, deployed, and it remains as a cycle. Particularly you have your ups and downs. You'll have your dry powder sitting in. Sometimes you have winter investment and so on and so forth. But this industry has been growing at a very rapid pace. Again, I think I've spoken enough in terms of what this particular industry has to offer. Let's understand briefly how the AIF regime looks like, or how is it conceptualized. So this is with a genesis of similar to what a mutual fund has to offer, but this is a privately pooled investment vehicle. And being a privately investment pool vehicle, it can be structured in the form of a trust. You can have a company, you can have an LLP, as the case may be. Whatever is permissible within the Indian regime at this point of time. This pooling vehicle definitely is fairly flexible to offer investments or invite investments from various investors. It ranges from domestic, you have got large value funds, you've got larger corporates, you've got foreign investors, you've got FIIs or FPIs who can go ahead and participate in this particular pooling vehicle. How is it conceptualized? How do you draw funds? Both the pooling vehicle is where this is more of a investment policy framework under a private pool, as I mentioned. And therefore, there are private placement memorandum similar to what an offer document is concerned or a prospectus is concerned, which is getting rolled out by these AIFs to draw investments from the investors. AIF usually is governed only by the capital market regulators, that is SEBI out here in India, and is not governed by any other regulator at this point of time. We have certain specific exclusions which do not form part of an AIF industry per se, and these are specific carve-outs derived from the AIF regulation, which is in the form of family trusts, which are specifically set up for family offices, ESOP trusts, or statutory trusts in the form of PAF, gratuity, and so on and so forth. Holding company structure also do not form part of an AIF regime per se. And we have specific regimes for securitization or ARCs, which falls under the business trust model. So this is nothing but an emanation or an upgradation of the VCF regulation, which was introduced sometime in 2012. And then post that, there was a probable window that was available to upgrade the existing VCFs or VC funds to get themselves re-registered under the AIF regulations. Broadly, the AIF regime is categorized into three parts. So you've got category 1, 2, and 3, while there are a couple of other parts also. We have got angel fund, we've got special situation funds, but primarily we see either it is a AIF category 1, 2, or 3. And what are the subtle differences or the characteristics between these categories are that AIF per se has a potential of providing a spillover effect in your economy, and which I think the governments have recognized here in India, including the regulators, and they have a specific cell to pay a lot of attention as far as this industry is concerned. And I'm sure you would have heard sometime this year and between this year and last year budget that the Prime Minister makes it a point every year to spend some time with the private equity segment. And this is nothing but the AIF industry per se. So much before the budget gets rolled out, there is a dedicated discussion with the Prime Minister at the round table in terms of addressing a lot of their concern. So category 1 typically talks about where there is an incentive which is also granted by the government. These are government-backed funds, these are social funds. Infrastructure sector also falls under this particular categorization, especially when you have certain SOPs which have been granted under the income tax regime. Startups, angel funds, incubator funds, they typically get classified under category 1, which are granted certain benefits from DPIT, which is Ministry of Commerce Affairs. I will quickly jump on from category 1 to category 3, especially category 3 allows you to pool in vehicle, and especially for the investors to make wealth creation in the capital market segment. And why is it so? Is I will again further deep dive in terms of what category 3 has to offer, particularly where the focus and the thrust area remains on the capital market side. So it could be in terms of trading activities related to securities, fixed income, heavy churning, be it FNO, or followed by pipe deals and so on and so forth. And what are the categorization under category 3 is where you have hedge funds, long short funds, which typically derive complex strategies to make alpha on the returns when it is concerned for the investors. So whatever does not fall under category 1, which are not innovative funds, infra funds, and so on and so forth, or for that matter, category 3, which does not focus primarily on the capital market side and which are not qualified as equity funds or hedge funds, as the case may be, the residuary fall under the category 2 bucket. And then anything which is not a category 1 or 3 will be derived or will have to seek a registration under category 2. And they are particularly classified as PE funds, you've got debt funds, even fund of funds are ideally categorized under category 2 per se. So that's a broad categorization under which AIF regime is classified. Let's talk about in terms of what are the key conditions, guidelines, procedures that needs to be followed across common conditionality, and then there are specific conditionalities prevalent for category 1, 2, and 3 as the case may be. So we discussed in terms of the eligibility of the fund. It's a pooling vehicle. It's established almost similar to what mutual fund has to offer. And very necessarily, there's always a caveat, since it is a private pool vehicle, there are no guaranteed returns that can be offered by these private pool vehicles. And that's a caveat with which it comes into the offer document per se. How do you go about registering and what are the eligibility criteria? The by and large eligibility criteria is that you can be set up as a trust, which is extremely popular at this point of time. If you were to register as any other legal entity, of course, even that is permissible under the AIF regime. But by and large, if you look at more than 98% of the fund which have been set up in India, they are typically set up in the form of a private trust. So that's the construct with which an AIF is registered. Followed by that, as I mentioned, this is private in nature through an offer document. You cannot have this in public domain. So if you were to Google up in terms of, can I just look at any of the PPM? So there are, by the way, these 6 lakh cumulative investment commitment into AIF is by over 900 AIF which have been registered here in India across categories between 1 and 3, right? And you Google up most of the asset management companies, you will not find any of the PPMs available in public domain. I'm not talking about some of them accidentally, they have been, uploaded on these public domain websites. But by and large, these are offer documents which are extremely private in nature. Most of them are password protected. That is what and how capital market regulators want these AIF asset management guys to behave. And therefore, you will not find these PPMs available readily in the market. Who are the participants who make this operative? So you have an applicant, which typically is the asset management company who ideally floats these pooling vehicles. You have the sponsor, who ideally is nothing but similar to what an anchor of an anchor of a issue is. So when you look at an IPO, you have an anchor investor, right? So you have a similar concept as into an AIF, like a sponsor. And then you have the fund manager, which is the asset management company, who has to be eligible to float these entities per se to be registered with SEBI. Who are they? What are their requirements? So they need to be eligible in terms of their professional qualification, followed by they need to have adequate experience in the capital market segment, which at this point of time remains to be more than 5 years. The entity which is an applicant should have sufficient infrastructure, manpower to handle such kind of a pooling vehicle, depending on your scale and size. And then what is it that makes this particular application viable with SEBI is that at the time of making a registration, you need to be clear in terms of your thoughts, of your objectives, who are your target investors, the proposed investee companies, the key attributes of your investment management team, the strategy that you would want to define, and so on and so forth. So as we move along, I'll just walk you through in greater detail as well. Particularly, this fund has to be with a tenor of at least 3 years. That's the minimum threshold tenor that has been prescribed. So anything lesser than that does not qualify for a registration. Moving ahead, let's now certainly talk about key conditions which becomes applicable for a category 3 fund. And just to reiterate, this is more of a hedge fund or a capital market fund, so as to call it. So they are broadly engaged in trading activities in the capital market, be it a long short or could be a long only fund, investing into securities and then holding themselves back with a combination of fixed income strategies, be it, it could be corporate bonds, government securities, and so on and so forth, followed by certain derivatives or hedging activities. So what are the investment conditions for a category 3? So the earlier condition that I mentioned is on the eligibility and the registration. That by and large remains the same across categories. When it comes to key conditions for category 3, it has to have a minimum corpus of 20 crores with a minimum investor ticket size of 1 crore. There's an upper cap for allowing these participation of investors to the extent of 1,000 investors in numbers. And then, as I mentioned, that you need an anchor investor into this particular fund. So similar to this, you have a sponsor commitment, which in category 3 is 5% or 10 crores, whichever is less. So that's a base minimum criteria with which one has to start with. If one were to start with, say, a bare minimum corpus of 20 crores, then in this particular sponsor commitment, 5% would be of 20 crores, which is 1 crore. And the balance 19 crores has to be raised from third-party investors or even friends and families, as the case may be. So that's where you typically start with. And then the upper limit is 10 crores, depending on the scale and size. You also have employees, directors of the investment management team, and I'll walk you through in terms of the structure also. But these employees or the directors of the asset management company who are operating these pooling vehicles can also participate with a lower threshold of as low as 25 lakhs. And not necessarily 25 lakhs. If you have certain key functional fund manager or key personnel, you can also allot them units of these AIFs, which are typically free of cost. So it is nothing but in the form of a carry. So that's something which can be looked at. And, these jargons may look a little bit alien to the group as such, but carry is nothing but more of a performance fee, which you would ultimately derive at the end of the tenure of the fund. It's nothing but akin to a bonus. Let's put it this way, in simplistic terms. Category 3 can also leverage. So you can allow a category 3 to borrow from external participation. And of course, it comes with prudential guidelines and norms, as the case may be. So as in when we move along, I'll walk you through in brief, because this will become a heavily loaded subject. So I will just quickly touch upon the key aspects which are there into the industry, and then definitely share the material with you. So leveraging is possible. So if you have a corpus of 20 crores, then you can equally borrow it from the market and then make your investments or deploy that to create alpha or enhanced returns for your investors. Okay. Now these investments under category 3 come with a concentration limit. So again, SEBI being mindful of the fact they don't want you to just go ahead and buy Reliance, okay, from this 20 crore corpus of funds. They typically want you to diversify the portfolio. So in effect, what they've said is that if your corpus or particularly net asset value of the corpus of the fund is say 20 crores, then 10% of that particular corpus can be invested in just one security. Not more than that can be invested. So in this particular scenario, if one were to look at a corpus of 20 crores, then not more than 2 crores can be deployed in Reliance. That is how investment concentration limits are guidelines have been talking about, right? Again, under category 3, you have an option to do intraday activities, derivative activities. You also have an option to participate in Nifty futures, Bank Nifty, Fin Nifty, and so on and so forth. Now, interestingly, in such kind of products, when category 3 invests, there is no concentration limit which applies, because a Nifty or a Bank Nifty itself constitutes of an underlying of more than 50 scripts per se, right? So then inherently the concentration limits have been satisfied. That's a better view that can be taken, right? Most of these funds, as we move along, and I would try and talk about this caveat time and again, that regulators being extremely mindful of a fact that they do not want concentration, but at the same time, they do not wish these pooling vehicles to focus and invest only in their associate entities. And therefore, what they have brought in a caveat or probably a roadblock for these funds is that, look, if you were to invest in any of your associate or affiliate entities per se, then definitely you will require 75% approval of your existing investors in value before you actually get into such kind of affiliate investment opportunities. So in effect, if I were to say that, out of say 20 crore fund, right? If I were to look at investments into my group companies, then I can't do that till the time 75% of my investors in value have approved this investment into my group companies. If you are not doing that, then you are clearly under violation. That is what SEBI is completely looking at nowadays, right? Moving on, similar key conditions, want to examine it for category 1 and 2. And just to reiterate what category 1 and 2 is all about, positive spillover in the economy, primarily related to private equity funds, debt funds, stress assets funds, and so on and so forth. What are the key attributes and investment conditions? So leverage is certainly not possible in category 2 or 1 per se. Of course, it comes with a limited opportunity of leveraging to the extent of maintaining a working capital funding requirement is where you can go ahead and make a leverage. So not more than 10% of your corpus can be considered as leverage into category 1 and 2. Unlike a category 3, you can consider twice the amount of your NAV as a leverage from the market. And that includes even probably, kind of exposure limits that you look at exploring capital markets. So taking our previous example of category 3, if I have a 20 crore corpus, then the max that I can go ahead for leveraging or borrowing into category 3 is 2x of my corpus, that is 40 crores. So I cannot breach more than that. In simultaneously category 1 and 2, I cannot do any leveraging except for meager working capital leveraging that is possible, which is to the extent of 10% of the corpus. And then you also have windows to repay them back, right? In category 1 and 2. So that threshold is not more than 90 days. So within 90 days, you have to keep on repaying because it's not a perpetual borrowing. That is how category 1 and 2 leveraging concepts have been construed, right? Now, similar to what category 3 prescribes a sponsor commitment, you also have it in category 1 and 2, and this remains as equally half than category 3. So which is 2.5% or 5 crores, whichever is lower. So in the previous example of category 3, it was 5% or 10 crores. This is half of what category 3 has to offer, right? Here, the investment concentration limit is not 10%, but it is 25%, right? So here what they effectively mention is that any investments that you make cannot be more than 25% in a particular investee company or a portfolio company. You can go beyond that. So in effect, if I have say 20 crores, then ideally in category 1 and 2, I will have to make 4 investments. So it minimizes your cost of making these investments, divestments, and so on and so forth. So that's where category 1 and 2 lie, right? Very important condition under category 1 and 2 is that these funds can make investments primarily in unlisted only. And that has been defined into the AIF regulation, what primarily means. So for example, if I have a hypothetically 100 crore fund, then not more than 51% can be invested in unlisted. That is primarily. So 51% is what you can invest into unlisted. The regulators are fine. The balance 49%, you can go ahead and explore any form of structured curated product. So you can make investments in listed per se and so on and so forth. And mind you, very importantly, the fund regime under the AIF regulation does not allow you to access tangible investments. So for example, all investments under AIF can be made only in securities, be it listed or unlisted. You cannot go ahead and buy real estate assets from these funds. So you cannot access a loan agreement from these funds. So these are specific restrictions where AIF does not allow you to do that. Okay. So at best, what you can do under AIF category 1 or 2 is stick to 51%. You can go higher. There is no restriction. But yes, if you wish to diversify your strategy between listed and unlisted, then 51% is the bare minimum that you'll have to make investment into the unlisted securities. Moving ahead, you also have an option to make investments in units of other funds, which was earlier not possible. So now there is a concept of fund of fund also. So I, as an AIF category 1 or 2, or even 3 for that matter, go ahead and make investment into another AIF fund. So that option is available, including investments in REITs, InvITs, and so on and so forth. So these are investment pool vehicles where AIF regulation allows an AIF entity or category to make investments into other fund managers' strategy. Importantly, category 1, 2, and even 3 for that matter is granted a QIB status under the ICDR regulation. And what is the QIB status? It is a qualified institutional buyer. So for example, if I were to subscribe for an IPO, then I will be regarded as an institutional buyer to subscribe for those IPOs and need not necessarily fall under the retail category. And particularly so when you look at these offer documents under IPO, there is a larger amount of allocation that is available for institution status. So you have DIIs, which typically are likes of mutual fund and AIF. And then you have FIIs or FPIs who can subscribe under the QIB status, right? Now, similar to category 1 and 2, as I mentioned earlier, there are other categorization also, which is what we are not going to discuss today, because I don't want to make this heavier topic. It is anyways heavy. I don't want to make it heavier. So under the categorization of subset 1 and 2, there is another carve out of a fund, which is an angel fund or an angel AIF per se, which is a subset of category 1 only, which allows, incubators, innovators to set up this. The only respite under an angel fund is, it comes with a lower threshold of the fund size and a lower threshold of participation by the investors as well. So when you look at an investor participating in category 1, 2, or 3, as the case may be, the minimum threshold is 1 crore. In case of angel fund, it is as low as 50 lakhs. Okay. And it can further go lower for certain specified categories in terms of what we typically look at, right? So that's the angel fund regime, which we will not try and touch upon. but it is similar to what a category 1 is. Conditionality almost remains the same, except for the threshold of the investors as well as the investments, as the case may be. Moving on, there are other common conditionality which needs to be complied with between AIF category 1 to category 3. So what they are is that investment manager who typically manages these category 1, 2, and 3 are regarded as deemed regulated by SEBI. So not as a investment manager, I need not go to SEBI and say, kindly give me a license of AIF. No, it does not happen. It is only the pooling vehicle which has been granted a particular license, while I, as an investment management entity, remains an applicant with SEBI, but at the same time, the registration is granted in the name of the fund. So it's a composite cumulative registration which is available from SEBI. And I am regarded, investment manager is typically regarded as a deemed regulated entity in the eyes of the law, right? AIF again will have to formulate their investment policies, and then are numerous policies that are prevalent, which has been provided by the regulations per se. So similar to mutual fund, they have their investment policy, they have their investment committee, they have their risk policy, is so as AIF will have to formulate, adhere to it, and keep reviewing them from time to time. So they will have to be stringently managed, monitored by the investment manager. Simultaneously, AIF regime also requires these funds to be valued on a timely basis. So as we are aware that there is a NAV which gets published for a mutual fund, similarly for a private pool fund like an AIF, there is a NAV which gets published. Now, when you look at category 1 and 2, the valuation mechanism for category 1 and 2 has been prescribed to be at least biannually. However, if the investors were to grant a respite that I would want a valuation to be conducted just on an annual basis, looking at the express consent from the investor, even that is possible. However, this threshold remains on a lower side when it comes to category 3. So it could be varied from daily basis to quarterly basis to, for that matter, monthly basis, as the case may be, depending on how you would want to structure your fund and the documentation, right? There are enough reporting guidelines which have been now prescribed by the regulator, that is SEBI, which clearly talks about having policies, guidelines in place, and that needs to be adhered to, by the investment committee, by the investment manager, by the trustee, and so on and so forth. So while I may be talking about these intermediaries, as we move ahead, I'll walk you through in terms of how the structure looks like, what are the key participants to these particular structure, and what are the guidelines that they will be obliged to follow, right? There's another condition and another intermediary who comes into play when it comes to an AIF. So mandatorily, a category 3 has to appoint a custodian. There is no choice, whether you are a 20 crore fund or whether you are a 2,000 crore fund. However, there is a little respite for somebody in category 1 and 2, that unless and until you exceed the threshold limit of 500 crores, you need not mandatorily appoint a custodian. Now, who is a custodian? He is a caretaker for and on behalf of the trust. If it is set up as a trust, then he takes care of the operational and the administrative activities for the fund. So, for example, safekeeping of the securities, routine reporting and integrating with SEBI, probably following the instructions of the investor as well as the asset management company, and simultaneously, helping the fund to make periodic reportings with SEBI, or as the case may be, for the investors, right? Very interestingly, what was prescribed is that any AIF now who intends to participate into a fixed income product, like say, for example, NCDs, corporate bonds, and so on and so forth, then necessarily SEBI came down with a circular that at least 10% of their total secondary market portfolio should be placed through an RFQ platform which has been devised by SEBI or RBI, as the case may be. So it's request for quotes platform, especially. So most of these fixed income products are either bought through over the counter or OTC, or they are primarily subscribed, and which is where regulators have been promoting these in-house platforms which have been devised and approved by SEBI, that rather than having unregulated markets for corporate bonds, NCDs, and so on and so forth, the AIF who have got secondary market deals, then out of that 10% should be from the RFQ platforms. RFQ, that is what has been prescribed. And these are the conditionalities which will be tested by SEBI from time to time on a periodic basis, as and when there is an inspection. So similar to what income tax has got scrutiny, SEBI is also performing scrutinies on periodic basis. So earlier it was random between 4 to 5 years. What we have seen as a trend, regulators have set up a separate wing of investigation or scrutiny wing, where they have been performing these checks for the AIF, particularly when you have got larger investors participating in these funds, to be performed on at least 2 to 3 year basis now going forward. Moving ahead, this is how typically an AIF structure looks like. So we've got a fund management entity. If you can see my pointer or the arrow as far as the fund management entity is concerned, this can be structured into a form of a company or an LLP, as the case may be, okay, which effectively manages a pooling vehicle, which is a SEBI registered fund. So it could be structured into a form of a company, trust, LLP, as the case may be. And then you will have to comply with minimum sponsor requirement, as and when you intend to raise capital through a private placement mechanism. The fund will get registered with SEBI. You will have to name these participants. So you've got your custody. If it is a capital market activity, then you have got a clearing participant. You have a trustee who is a caretaker of the trust per se. If it is a pooling vehicle, is a trust. You have a fund administrator. You have a banker. You have a broker. And so on and so forth. You've got, of course, consultants and auditors, tax advisors, who play a very vital and key role in setting the entire structure of an AIF. Okay. Representatives of the AIF and the trustee can be in the form of an investment committee, or you can also have, if it is a small fund, then you have a fund manager who satisfies these eligibility criteria to take these investment decisions. And as we move along, I'll talk about what the investment committee constitutes all about, what are the guidelines in and around that prescribed by SEBI, right? Especially when an AIF apparatus has been set up. So after you've set up an AIF, which is where you will have investors coming into play. So if you look at the previous structure, it does not have investors. Now you've got these investors who will be putting in money into the fund, a trust vehicle, and they put in money through a contribution agreement. So a trust will typically issue a contribution post the PPM or the private placement memorandum, where they showcase the investment strategy, the size, and so on, and the investment thesis of this particular fund. The investors would want to participate. The investors participate and sign a contribution agreement, basis which they put in money into the fund. Okay. And post the investment which is being made by the fund into these investee companies, considering the decisions made by the fund manager, is where you start generating income. What are the peculiar form of income that these AIF generate? Is in the form of dividend, probably interest in case of debt instruments, and capital gains on exits per se. And at best, you can have other income which could be in the form of compensatory contribution, or any other form of other income that one fund can derive. But these are the core income investment attributes with which you would have in an AIF, which is dividend, interest, and capital gains per se, and which effectively between category 1 to 3 will be distributed through a report mechanism to the investor, and then which is followed by certain tax implications, certain regulatory implication in terms of how should it be looking like into a statement of account, and as the case may be. So these are particularly shared, derived by the fund to the potential investor. Now, again, being mindful of time, I'll just quickly brush upon few of the concepts as we move along. I'm sure, as we discuss ahead in greater detail, you would get a glimpse in terms of how these jargons pan out, what do they mean, and how do they typically operate. So what are the key attributes of an AIF? So you have a fund, you have a fund constitution, you have a fund life. So you'll have to define the tenure of the fund, which would be at least 3 years and can be, on the higher side. I've seen some funds to be as high as 15 years, right? And then you have to define the size in terms of the quantum. So today, the bare minimum is 20 crores. It can be, depending on your ability to raise funds from the market, either independently or through the distributor mechanism, could be ranging between, say, 20 crores to 100 crores, and the investment strategy, as the case may be. You have to define the sponsor, the commitment period will be defined, you'll have a closing. So today, if I'm into a fundraising mode, then typically I don't do a closing. Until the time I don't do a closing, I cannot make investments. So that's the connectivity with which, you have to have and announce your closing of the fund, right? And then there are post-closing events, which completely focuses on the investment related activities. And then you have got investment managers and the trustees. Who are the investment managers? What are the roles that they play? We'll discuss them as we move along. But the investment manager typically defines these fund constitution documents, and they are in the form of establishment fee, operating fee. So these are nothing but setup fee, which will be charged to the investor. You've got your management fee. So a fund manager would want to charge a management fee to the investor basis the operation of the fund. So that's the kind of salary that he makes. It's typically referred as management fee, but otherwise that's the salary he makes from these investors or these pooling vehicles. And at the end of the term of the fund, I would want to make my bonus. So which in that particular terminology is referred as carried interest or performance fee. The fund management is done, if it is a trust, is effectively done through a trustee. If it is in the form of a company or an LLP, then you'll have designated partners or the directors, as the case may be. So they will be in charge of the fund, especially, and who takes the responsibility and onus from the investment manager. You have the investor. So into an AIF, they play a very key and an important role, because they are the guys who bring in money. And post the contribution agreement, they will be granted class of units depending on the scale and size of investments that they have pulled in. They need to know the distribution waterfall. The distribution waterfall is nothing but a simplistic illustration basis, which if I were to make an investment of $100, then what is it that I will reap after 5 years? What is it that I will get in the form of income, be it interest, dividend, capital gain, and on the winding up of the fund, I will get my entire capital contribution back. Okay. The compensatory contribution. So for example, a compensatory or a CC, as we typically call it as, is very popular in the form that if I'm a late entrant into the fund, and if there are early stage investors who have already contributed, then, and if the fund has started making certain temporary investments in the form of liquid funds, there are certain defined temporary investments. So you've got CDs, CPs, and so on and so forth, T-bills. Then as a late entrant, I will have to compensate the early entered investors. And that typically is referred as CC. It has got a function of time value of money followed by the investments which have been made by the fund post the first closing that has been done by the fund with SEBI. So that's typically an additional income which resides into the fund from the late entrants. Distribution proceeds post tax pre-tax, and then these calculations are based on certain return calculation of hurdle rate, the carry, the catch up, and so on and so forth. So these are quick terminologies that I wish to share when it comes to an AIF. Okay. Now we've understood the eligibility criteria. We know what are the broad-based investment conditions look like. And we know certain compositions of the investments, including the attributes into an AIF. Let's quickly jump upon certain operational and prudential guidelines which apply to certain category of funds. Now, in this particular case, I'm discussing purely related to category 3 because category 1 and 2 are by and large liberal in nature in terms of satisfying operational or prudential guidelines. However, the prudential guidelines are more stringent or slightly heavier when it comes to category 3. And what are they? So there is a frequent reporting mechanism, while fortunately SEBI bases the recommendations which have been made time and again to the regulators in terms of practical difficulty of making these reportings on a high frequency basis. Regulators have bought this theory to allow category 3 also now to make these reportings on a quarterly basis. Earlier, it was on a monthly basis. So now reporting requirements are prescribed for all AIFs. We've got risk management and compliance that needs to be heavily complied with by category 3. It equally remains important for category 1 and 2 also. However, for category 3, since there is an enhanced advantage of having leverage, so you have to meet and comply with prudential guidelines of leverage as opposed to category 1 and 2. The redemption requirements are prescribed under category 3, so especially when you are an open-ended fund. So as I mentioned, a fund can be an open-ended or a closed-ended fund. A category 1 and 2 is usually a closed-ended fund, by and large. And category 3 can be a combination of category a closed-ended or an open-ended fund. But predominantly what we've seen is category 3 is an open-ended fund. So you allow the investors to participate at any given point of time and allow them to exit at any given point of time. And these can be, flexible depending on how you wish to write your private placement memorandum or PPM as we call it. There are periodic reportings over and above what you make to SEBI. So there are specific reportings that needs to be made to the board of directors of the investment management entity, which are in the form of QCR, that is quarterly reporting. You've got your CTR, that is compliance test reporting, which is again done periodically on a quarterly basis, right? And then winding up has to be complied by all the funds basis their tenor of the fund which has been prescribed. You also have an option to make extensions with SEBI, and these are formal writings that will have to be written with SEBI through a prior approval. Moving ahead, as I mentioned, so you have reporting, and let me talk about primarily category 3, because that's more complex than category 1 and 2. So there are frequent reportings which are being done with SEBI, and thankfully SEBI has allowed us to report in a digital mode through an online mechanism than in a physical mode. And category 3 have now been permitted to report on a quarterly basis. A NAV reporting can happen on a monthly basis, although you can, with express approval from your investors, you can have it on a frequent basis, or probably on a deferred basis, could be 2-month or a quarterly, as the case may be. These reportings have to necessarily prescribe the disclosure of any fee which are being made to the affiliate or the related party transaction of the investment management entity. And that's extremely necessary. Some of these disclosures like QCR or CTR reportings that I mentioned, they are time bound in nature. So that needs to be done within 30 days from the end of the financial year. So for this year, we've completed our QCR, CTR reportings on or before 30th of April, right? And then you've got certain ancillary reportings that needs to be done. So you need to take your GIN number, because of the institution status. You have foreign investors coming in, so LEI codes have to be in place. You will have you will be granted a separate scores registration from SEBI, where it is primarily to address investor grievances and redressal mechanism in situations of certain complaints, right? So these numbers will have to be disclosed into the PPM, and then followed by, you also have certain FIU registrations which will be made under the PMLA guidelines. Moving ahead, one will have to ensure that there is a robust risk management and compliance in place. Regulators of late has been extremely vigilant of funds who have not been complying with periodic reportings, maintaining these policies, procedures, following these criteria for be it leveraging, investment, as the case may be. And as early as last week is what we came to know, that regulators, in absence of these compliances, have cancelled licenses of as high as 8 AIFs. And once an AIF license has been cancelled, it really becomes very difficult to convince SEBI to revive these licenses, or for that matter, obtain a new license for a particular strategy or a scheme that you wish to launch, right? So you need to be thoroughly compliant when it comes to your risk management policy, or be it leveraging policy, as the case may be, right? So comprehensive risk management policy, this is again defined from SEBI, that needs to be complied with. The compliance function should be supported by sound control and operating mechanism with a suitable infrastructure that needs to be in place, such that that can be monitored on a regular basis. There are certain counter reportings which also go to the custodians. That is basis the risk compliance process and procedures are concerned. There has to be maintenance of suitable records, and that needs to be maintained for a span of 5 years. As and when SEBI were to come down to with inspection, that needs to be furnished to them for their inspection purposes. There is a lot of focus of the capital market regulators now, be it dealing with conflict of interest, where you have got investors investing are completely related to the investment manager, or the fund entities specifically, as I mentioned, making investment into the group entities, or certain investors having a concentration of their investment into the fund. So that conflict of interest has to be amply disclosed to the existing investors, and where necessary, if required, certain consent may also have to be obtained from the existing investors before allowing these conflict of interest to be addressed by them, right? Moving ahead, in terms of specifically related to leveraging, as I mentioned, is available 2 times the NAV for category 3. Then there is a specific mechanism to compute this leveraging and reporting this with SEBI, and which is the derived formula. So you've got total exposure that has been made into the capital market, which includes long plus short. Again, long plus short is long in terms of a buy and hold strategy, and then short would be nothing but an F&O strategy that is in place. And depending on your investment strategy, you have an option available to set this set off between these positions or counter positions that you've taken to derive your leveraging threshold, whether it meets the 2 times the NAV or the investable fund criteria or not. If there is a breach in place which is more than 2 times, that needs to be reported to SEBI through your custodian, and that needs to be rectified within a span of 5 days. These are 5 working days. Having said so, these offsetting mechanism between long plus short, as the case may be, are ideally prescribed or derived from an old circular of 2001 issued for mutual fund industry. And having said so, otherwise, this leveraging mechanism will be computed on a gross basis, right? So this is something which I've mentioned as far as leveraging goes. Redemption norm, this is again extremely vital for category 3, especially when category 3 investors are broadly and is an open-ended fund. So the redemption norms will have to form part of your PPM, both for existing as well as new investor. At what point of time the redemptions can be made? What are the notices that will be issued by the fund to the investor when a redemption request has been made? What are the mechanism as far as the NAV calculation is concerned for computing the redemption which has been made by the investor? There could be certain exceptional situations where the redemptions may have to be suspended. Like, for example, if there is a drawdown. Now, what is a drawdown? Is nothing but if an investor is obliged to bring in, say, minimum threshold investment of, say, 1 crore, and the fund does not expect the investor to bring that 1 crore on day one on the signing of contribution. But if it is staggered in or on a periodic basis, and particularly the investor does not commit the drawdown which has been issued by the investor, then in that situation, the units of the investor will get suspended. And as a consequence of that, the redemption which is being made also by the investor may stand suspended. Then there are consequential mechanism, rectifying or cure mechanism which is prescribed into SEBI, which will have to be satisfied before undertaking these redemptions, followed by certain exceptional scenarios which will be specifically defined into the PPM per se. So let's understand, a PPM is nothing but a Bible when it comes to, for an AIF pooling vehicle. Importantly, the redemption norm will also specify when the redemption cannot be made, especially what are the scenarios to be rectified, as I mentioned earlier. And then there will be an active review, constant monitoring by the fund manager to understand and improvise the suspension, or probably for that matter, redemption mechanism on a periodic basis, right? Moving ahead, so we've seen how do you set up your fund, what are the brief operating guidelines, including investment guidelines that needs to be followed, including the risk management policy, followed by the investment policy that needs to be satisfied with redemption policy, as the case may be. And then finally, a stage comes when most of these funds, in situations like that of closed-ended funds like category 1 and 2, will eventually wind up post the completion of their tenure. So there is a winding up clause or a chapter which is written into the PPM, and that necessarily talks about the actionables which needs to be undertaken by the board of directors, the the designated partners, the trustee, when a winding up is triggered. Okay, so for example, if it is a winding up of a trust, then the trustee will have to come into play. There are certain notices which will be issued to the existing investor. They will have to ensure that all the distribution of income is made much before the winding up takes place, and so on and so forth. Interestingly, when the winding up is triggered in, there cannot be any investment which is being made after such intimation of winding up is made. Having said so, there are extension periods which will have to be obtained from SEBI. So in case if you wish to still go ahead and make an extension of your fund, if you have made a request for winding up, but you believe that some certain investments are stuck because of illiquid scenario, then you can apply for extension with SEBI. So necessarily at the time of winding up, you have to ensure that all the assets have been liquidated to ultimately make a distribution of income, as well as the capital contribution of the investor post the actual liabilities which have been paid off from the fund, right? It is a similar treatment as that of any company per se. But again, you have got certain regulators who come into play, who will run past to and then probably oversee this winding up mechanism. This is a very interesting code which was introduced by SEBI from an AIF perspective. And why do I say this as a code? Because this is nothing but a practice of good corporate governance. This is what capital market regulators have been thriving for and inculcating as a behavior to be followed by most of the intermediaries by in this particular industry, and particularly so in AIF. So what is a stewardship code? This was a code typically introduced by Financial Stability and Development Council, talked about, set up through a committee recommendation, and which was formally adopted by various other regulated industries in the form of IRDA, like insurance, you've got PFRDA, and so on and so forth. And then basis the guidelines issued by IRDA, PFRDA, which was an extreme success in their particular regulated segment, was formally introduced across all categories for the AIF industry as well. So this was simply adopted by SEBI in a different avatar. This got formally approved somewhere in July 2020, which was definitely a COVID year. And what we saw between 2020 to 2022, the entire AIF regime has undergone a revamp. Okay, because that was a specific leisure time for the regulators to draft interesting good practice policies, and which is what they've done and now is being thoroughly implemented by this particular industry. A stewardship code is nothing but a code which will have to be followed primarily in situations of listed equities where you have participation of voting, you've got certain corporate action which takes in place, and that needs to be disseminated to the investor in what form this will be followed. There has to be absolute transparency how the voting is happening, whether it is being done in the interest of the institution that is an AIF or not, and what are the privileges that are available through these stewardship code mechanism. In order to implement the stewardship code, the circular of July 2020 formally approved or defined a six-pronged approach into a stewardship policy, starting with principle one, by drafting a comprehensive policy framework, followed by managing conflict of interest in situations of investments which are being made by the investor directly, or for that matter, in the investment manager also in the similar set of investee entities. There has to be a continuous appraisal approach of performance monitoring of these stewardship codes which are in place, followed by intervention and integration of policies for ultimate investors. So as and when there are red flags by the investor, that needs to be taken care of, and that needs to be adopted into the stewardship policy as such. There has to be a disclosure of voting activity policy in place when it comes to stewardship model, which has to be adopted. And then this is followed by periodic reporting of these stewardship activities to the investors, or dissemination of these information as to how it has been followed and complied with. So in brief, I'll just quickly touch upon as to these six-pronged principles of stewardship, defining a comprehensive policy that needs to be formulated, defined and designed as to how this will come into play, what are the periodic reviews which will take into place, the representation that will be made to the trustee, the recommendation from the investors, and so on and so forth. Followed by what is the active conflict check mechanism in place if one were to simultaneously invest either through a co-investment mechanism, or there are existing investors who would wish to influence a voting right into a particular corporate action when it comes to the investee company per se, and how these situations are practically handled with appropriate rationale, as the case may be. There has to be a continuous, as I mentioned, performance monitoring or appraisal mechanism in terms of reviving the corporate governance, the strategies, the risk policies, and so on and so forth. And timely intervention and integration of these policies for the ultimate investors to protect their interest will have to be complied with, especially if there is a investor complaint which is being made, then that needs to be addressed through these assessment mechanisms. A disclosure of voting activities which will be done, especially those, so there cannot be a random voting which will be made for or against a particular policy matter which is being done by the board of directors of the investee company. There will be a consensus in-depth analysis before you actually arrive in terms of supporting the management or raising a red flag against the decision of the board of directors of the investee company. And then this will be followed after you've done all these comprehensive analysis, the conflict checks, disclosure of voting policies, the mechanism with which it is being voted. The investor now has the right to know in terms of how is he benefited out of these stewardship responsibilities which are being adopted by the investment manager. So that needs to be into an easy format to understand that how these voting or the rights have been exercised by the investment manager, being an institution in the investing company. Right? Moving ahead, this is extremely important as far as the disclosure standards are concerned, introduced by the AIF regime sometime in 2021. And 2021, why do I say? Because it was in the form of a consultation paper, and then that is where it got formally implemented, right? What does the standard disclosure mechanism entail? This was introduced to primarily create a homogeneous effect as far as the AIF industry is concerned, how the document or the PPM is written, what are the clauses, standard clauses that can be maintained across category 1, 2, and 3 as the case may be, such that the investors can take an informed decision before participating into these complex funds. Okay. And at the same time, it also offers a transparency for the AIF to understand if there is a particular clause, so how it has to be read, what are the standard mechanics to read these particular clauses, and where do you find them into the PPM. So that's where the standard disclosure norm was constituted. And again, this had a two-pronged approach. One is there was an introduction of minimum benchmarking standards for disclosure of performance of a track record of the AIF. So similar to what a mutual fund is. So today, if I have to buy a mutual fund, for example, then I need to know that am I really benefited out of that particular strategy, and whether that strategy which I'm intending to adopt, a similar strategy is being run by any other asset management company or not. And if yes, then what are the performance track record of that particular fund, which I can compare it with this today, right? So these are the disclosure of performance related track record of AIFs that needs to be prescribed or has been prescribed now under the minimum benchmarking standard, and which is already in place. And this primarily avoids any sort of mis-selling of an AIF product to the investor. So earlier, in absence of any particular benchmarking that was available, the investor had to go at the whims and fancies of the investment manager to say that, look, and these are all verbal in nature, as we mentioned, that there cannot be any guaranteed returns that can be written into the PPM. But verbally, he always had an ability to influence the investor. Look, I will make a 50% return. Now that has done away with. With a minimum benchmarking standard, if you have a particular adopted strategy, that strategy as an industry benchmark with more than 900 AIFs in place, and mind you, these are licenses I'm talking about. These licenses have further dissection of sub-schemes and funds which have been launched. So you can say probably as high as 5,000 schemes or funds have been running at this point of time under AIF. Okay. So now as an investor, I have an option to compare my strategy with the available benchmark. So what are the kind of typical returns that are generated in such kind of investment thesis? So that's one disclosure that needs to be made by the AIF into the PPM if it is established. The second is standardization of the PPM. So there was a ask from the investor as well as the investment management team that look, there are PPMs which are random in nature. The PPM is written in any form whatsoever without having any control in terms of the distribution, charging of management fee, and it's all over the place. So SEBI, in order to streamline this particular effect of a PPM, introduced a standard PPM concept for across the categories, where you'll find that this is a defined standard that needs to be complied with, and within that you can have your language variation. So that's the standard disclosure which has been introduced under the AIF. Now I will not try and talk about too much into these standard documentation because they are available in public domain. And as I said, and I'm mindful of everyone's time, today is a Saturday. I would like to complete this on or before 9 o'clock because it's an extended topic. I can go on and on and on. And I have got substantial amount of data and information to complete. I've got nearly 80 slides to complete. We are just at 23. So I'll just try and give you a glimpse in terms of what are these aspects related to. And maybe, after I send out this material, or if any of you need some material in greater detail, feel free to reach out to me. I'm happy to share them for your reading. Right. So in nutshell, as I mentioned, minimum benchmarking have been introduced where performance track record will be mentioned into the PPM for somebody to compare. Mandatory benchmarking, including for all VCFs have been prescribed. These benchmarking typically are governed by a certain authorized agency, and these agencies are adopted or appointed by SEBI per se. These are in the form of associations, right? And they are recognized association whom you can, as an investor, rely upon. Okay, who will provide a track record of a particular fund, of a particular scheme, for you to easily compare and ensure that they are readily available into a promotional or a marketing document of the fund management entity. So if I were to say that, look, this is a long only strategy focusing only on, say, infrastructure segment, then we are certainly confident that within a 5,000 plus scheme which has been run into an AIF, you will certainly find a benchmarking agency comparing an infrastructure long only fund which is being launched by an aspiring fund manager with an existing fund manager. So if I were to say that, look, I'm happy to make at least 20 to 22% IRR or return, and which otherwise is available with a 15% return in the infrastructure segment, then the investor today has an option to counter in with these benchmarking analysis. That's where the benchmarking helps the investor to take an informed decision. Moving ahead, who are the agencies? So today you've got CRISIL, you've got NSE, who have been compiling these data for the aspiring AIFs and furnish these benchmarking reports, which needs to form part of these PPMs or marketing document of the AIF before they actually sell their products to the investors. Okay. Now, again, there are various tweaks, there are various customization, bespoke benchmarking analysis that can be done with the help of CRISIL or NSE, depending on the nature of your investment strategy or the nature of industry that you will be dealing with. So certainly in such kind of situations, it is a consent-based approach of sharing data with these agencies. It is not automatic in nature. So the agencies will have to seek your consent. and which in turn you'll try and disseminate your data for their comparison. The terms and conditions are, again, as you mentioned, are private in nature. So that needs to be kept in sensitive area, especially there is no dissemination of these information available in public domain. And therefore it is awarded to CRISIL and agencies like NSE. And then followed by that, there is a possibility of converging this data into a form of a report. So it could be customized depending on the investment's theory and strategy and so on and so forth. So by and large, what are the form of activities which are being done under the performance benchmarking is the performance, the benchmarking data is furnished by the AIF to these agencies, which is on a periodic basis, half yearly, but as the case may be in the month of September and March, as the case may be. And then there are periodic audits which are being conducted for these benchmarking, which are being furnished to the investors, followed by the agencies. Customization obviously is required, as I mentioned. So this is depending on the industry and the investment thesis which is being written by the AIFs. Moving ahead, the disclosure document specifically talks about the valuation mechanism. So today AIF category 1 and 2 are biannually valued, and then followed by category 3. Typically it can be valued basis the publication of your NAV. So if a category 3 were to do frequent publication as high as, on a daily, fortnightly basis, then the valuation will have to be done on these many periodic basis, right? So that's where the valuation theory lies. Very important, other than what has been stated into the disclosure document, I would not want to read them verbatim, but an important point to be noted is that SEBI came down with a recent circular for SEBI for AIF to suggest that IPEV guidelines should be followed to make a conduct a valuation for category 1 and 2, as the case may be. This is nothing but in the form of a DCF mechanism that will have to be followed, and these are internationally defined principles that will have to be followed and prescribed with, right? Having said so, what are the reports that needs to be generated by the AIF industry is, as I mentioned, periodic reports which will get published in terms of the data which are disseminated either post September or March, as the case may be, comparing it with the industry benchmark. These performance data will have to be reported again in INR as well as USD terms, especially when you have investors who are offshore in nature. And then followed by that, you have periodic audits which are being conducted for these PPMs on a 6 monthly basis, and which are furnished to SEBI. Now, for example, if the fundraising has not happened, then there are certain respites which have been granted by SEBI to suggest that you can furnish a CA certificate saying that there is no fundraising which have happened. So that would typically suffice in terms of these PPM audits. And then followed by that, there are consolidated reporting which are being made of the PPM. So for example, on an annual basis, if there are multiple changes which have been carried out into the PPM, be it on the management fee side, be it on, adding certain class of units, or for that matter, as the case may be, there are certain key changes that needs to be incorporated into the PPM. For example, like the tax chapter, the important relevant circulars which forms part of the PPM per se, then those changes will have to be consolidated through a merchant banker report and then filed with SEBI on an annual basis, which is within 1 month from the end of the financial year, right? So that's that on in terms of the disclosure norms and the mechanisms. This is a very important disclosure that is now and going forward being made by a lot of these domestic funds, particularly and rightly so in terms of the investment managers bringing in new talent, new thought processes, and vibrant ideas from reputed participants or reputed personalities when it comes to in such kind of walks of life when it comes to making an investment or taking a decision, who can help them support taking the right kind of decision. And it was always an ask from the industry that, look, while the fund manager is competent enough to take an investment or make an investment or take an investment decision, we would need certain expertise who can be on the board. So for example, if I'm looking at a consumer market, I would always want the promoter of Nika, Miss Nair, to form part of my group and take in better informed decision when I am looking at some of the investment proposition. That gives a lot of strength in terms of consumer market kind of a strategy or a theory that I'm looking at, and will help me generate better returns. And at the same time, it adopts a theory of maker and a checker. So while I'm making a decision, I need a seasoned person who can verify and check my decision making capability, and whether can somebody who's an expert in this field stand by. So that's the investment committee theory, which was adopted by SEBI. And there are certain nuances in and around that, and which is that members can be in the form of directors, employees, as the case may be, and they carry the similar set of responsibility as that of the investment manager, who are featured into the PPM, who form part of the investment committee. So in case if there is a liability against the fund manager, then there is an equal liability which is to be borne jointly and severally in situations by the investment committee team as such. Okay, so that's very important. Second, you can have external members also forming part of the IC or the investment committee team, provided you've taken at least 75% investors approval, except for certain ex officio changes. There are certain exceptions and exemptions which have been prescribed, right? And these investment management committee team come with the same set of eligibility criteria, which is in the form of they need to be qualified, professionally qualified, followed by they need to have experience in the capital market. Okay. Interestingly, while IC committee was an international concept adopted by most of these funds, without forming part of the PPM sometimes, this is something which was noted by SEBI, and SEBI came with this formal circular to adopt IC committee into the PPM itself. So for example, what was stated is that if the investment committee team has got Indian citizens as members, then this can be easily processed by SEBI into the PPM. However, what was prescribed is that if the investment committee team constitutes a foreign national, then that typically requires an RBI rule approval or a clarification, as the case may be. So that's where the flavor of investment committee resides. AIF, again, there's a concept of large value fund or accredited investors, which is again derived from international markets, where these are sizable investors who understand their risk involved in making investment into financial services product. So they are informed investors, and which have been provided that in this particular circular, if the AIF invites investments from investors who are 70 crores plus, okay, then the policies or the procedures, be it in form of investment committee, investment policy, as the case may be, they can be diluted to a limited extent, subject to they granting their waiver. So it's something which, if predominantly the investment is from a informed investor, they understand how this particular industry operates, and these policies and procedures can be diluted to a larger extent, but it happens only through a formal waiver letter and not otherwise. So that's where the investment committee decision particularly lies. As I mentioned, again, staying with the disclosure standards for the AIF, the PPM standardization was also forming part of this particular concept. And as I mentioned, what SEBI did was to make a bare minimum PPM for the industry at large. So it includes the, or probably the elementary or the bare minimum standard of the elements which should form part of the PPM. For example, what are the classes, who are the trustees, what are the specific exclusion rights that will be granted, how many classes are being offered, what is the distribution mechanism, what is the redemption mechanism and lock-in mechanism, and so on and so forth. So what SEBI did was they introduced separate set of templates for category 1 and 2 because they fall under the private investment route mechanism, and category 3 particularly because it's an open-ended fund, and therefore there's a standard template which is available, and depending on your investment strategy and theory is where you will have to build up in those particular standard PM. So what it did was, for example, if a layman, or for that matter including SEBI, when it is reviewing a particular case at the time of its application, they clearly know where to look out for which clauses. Okay, and very interestingly, these PPMs have now been, while it was drafted by the lawyers in some time ago or sometime in the past, this is now being certified by SEBI intermediary, which are the category 1 merchant bankers. So which is where SEBI can rely on such kind of certification. So there's a certification process now in place to get these PPM approved, rather than sending these PPMs which happened some time ago and which was randomly sent to PPM, and then SEBI had to look out from pillar to post as far as these clauses were concerned, right? So what does it entail? There's a manual, so there's a mandatory audit which has been prescribed for the PPM, as I mentioned earlier, which is particularly on a 6-monthly basis from the end of the financial year. And what does it include is, it includes private professional attributes where you'll have a regulatory chapter, you'll have a tax chapter, which needs to be updated from time to time. Okay, if there are any corrective measures that needs to be taken post the audit, then trustees and board of directors or the governing body of the AIF will raise a red flag to the fund manager, and that needs to be rectified or explained as the case may be. Okay, and as I mentioned, there is a large value fund investor which is more than 70 crores. So there are certain PPM guidelines which have been diluted with. Now there's also an interesting circular which was raised sometime in September 2022, which classified that that earlier there was no mechanism of first close. It had to happen. It used to happen randomly. So what SEBI mentioned now, that if you have received a license, then within 12 months from that receipt of license, you will have to announce your first close. And first close is nothing but you have started your fundraising, you've brought in some funds into the fund, and you started now, after release or announcement of the first close, you started deploying them for your investment perspective. So there could be multiple closes, but at the same time, you will have to mandatorily do a first close within 1 year from the date of issuance of the license. That is what has been prescribed, right? Because some of the funds used to just carry on shadow funds without having investors. So that has been done away with. So mandatorily now, all of them will have to launch a particular fund and raise fund and start deploying them, right? I think most of it is probably covered here. Now, there was another interesting circular which was brought down in 2022 as well, that some of the curative and cute minds of the fund manager, what they used to derive was, they used to pass on their losses of the sponsor as well as the fund manager on a higher side to the investor, particularly. While the regulations, AIF regulation did not restrict their ability to pass on a higher set of losses to the investor, that did not go well with the regulator, as in when they were made aware of this particular strategy of the fund managers. So what was prescribed was that sharing of the sponsor or the manager loss cannot be less than the pro rata ratio of their holding. What it effectively means is that there cannot be any priority distribution of losses. You cannot attribute a higher loss to the investor and lower loss to the sponsor or the fund manager. And that was a theory basis which they have taken a higher risk. They have a first mover advantage and they were eligible to pass on these losses to the investor. That did not go well with SEBI. And what SEBI mentioned is that you cannot have this. And if you were to do this, then probably you cannot accept any fresh commitment or make any investments into the fund. Having said so, very quickly, I'll touch upon what are the good governance practices which were introduced between 2021 to 2023. And these are the key pillars of what SEBI has been thriving for, is where they've introduced this and allowed them to form part of the PPM, or for that matter, introduce them through a policy or a procedural aspect by the funds. So one is a code of conduct. So the code of conduct today is a laundry list of the code of conduct to be adhered to by the fund manager, the trustee, including the investor, and the board of directors of the fund manager. So there are certain lists that needs to be complied with by them. They form part of the PPM, and usually they have to be complied with in terms of high integrity and ethical practices. That is something which is being forming part of the code of conduct as far as the AIF is concerned. And the code of conduct has been introduced in slew of measures across all SEBI registered intermediaries. So whether it is a PMS, RIA, custody, or any other mutual fund, as the case may be, right? Interestingly, these code of conducts will have to be forming part of the PPM, should form part of the policy procedures, and there is an annual certification that needs to be also compliant with. So if there are any complaints thereof in relation to these code of conducts, that can be raised with the investment manager through a scores mechanism. There will recently SEBI also introduced appointment of a compliance officer in this particular case, especially so where most of these circulars or the mechanism will have to be thoroughly monitored by the compliance officer. Followed by, you have the investment charter, which is now forming part of the PPM, as well as it has to be now formally published on the website of the asset manager, which nothing but talks about the duties, responsibilities of the service providers, the investment managers, and so on and so forth. Followed by very important thrust and emphasis laid down on the investor grievances and redressal mechanism. And what does it entail particularly so is that any form of complaints will have to go through these particular investment redressal mechanism, and there will be a policy in place, again prescribed into the PPM, as to how the complaints will be dealt with by these funds and within what time will be resolved and published. And as a consequence, what has happened is that in the PPM audit or the consolidated PPM which is filed with SEBI, this has to be annually updated with the number of cases which have been raised by the investor, how is it resolved, and within what time span. So that needs to be disseminated on a timely basis. So these are the good governance practices which have been adopted by SEBI going forward on with the AIF. I think we are at 8 o'clock now. I think I'll just take 1 hour or so very quickly to browse and brush up. Post the administrative and the operation guidelines are concerned, talking about the key aspects. Let's talk about fewer concepts which got introduced. Apologies if I am unable to give you a break because there is enough things to cover, and these are the important aspects that I wish to let the participants know that how is this being practiced and what are the nuances around it. You have a fund of fund concept again, which has been recently introduced by the AIF mechanism under the AIF regime. And what it talks about is initially in earlier past, there was no mechanism for the AIF to make investment into another fund. Especially so that SEBI does not allow one fund manager to manage the investment activities of another manager, right? So delegatory authorities or concept is usually not prevalent into these SEBI related activities per se, right? However, in AIF, they have permitted an AIF category 1 and 2 to invest into another AIF 1 and category 2, except for they cannot invest into a higher category, that is a AIF category 3. However, AIF category 3 can invest into any form of funds of category 1, 2, and 3 as the case may be. Now, what it entails is it also allows the fund managers to create a new asset class for their activities or investment objectives. So, unlike you devising your strategy on direct equities, I would want to capitalize on certain fund managers who are making decent returns. But that happens only with a consent mechanism of at least 2/3 of the unit holders of my particular fund per se. Only if they allow me to do that, I will try and launch such kind of a fund of fund. Followed by what does it allow you to do that is potentially permit diversification of investment into multi-asset classes. So I need not concentrate on only one equity, and it helps the fund managers to prevent any leakages. How do I say so? Because if I were to particularly replicate a fund manager's investment policy, then there are certain leakages in terms of timelines. I may not be able to invest at the right time and exit at the right time. And plus there are cost leakages which effectively takes place. In cases of fund, I get best of all worlds under one roof. So for example, if I rely on say Rakesh Jhunjhunwala's theory, and he has developed a fund which is making an exorbitant and an extreme good return, then I need not replicate his strategy or a portfolio. I simply invest into his fund. So it's a fund on fund mechanism which is prevalent. Now, when I as an institution participate into another fund, then I also have an ability to probably optimize my costs. So the management fee that I intend to pay to a fund, unlike that fund deriving investors directly for onboarding purposes, can pass on relatively better or relatively optimal costs to me. So I may not incur heavier costs like a normal investor. So that's a clear advantage that we can sit on. Leveraging possibilities, as I mentioned, category 3, to the extent of the investment that you have made, twice of your corpus size is available and not otherwise. So category 1 and 2 is not permitted to do that. And simplified reporting and review mechanism can be placed when it comes to fund of fund, right? Special situation fund, as I mentioned earlier, and when you look at on the left hand side, the architecture of a special situation fund, just before COVID broke out, if you see, the NPAs of the banks was exorbitantly high, and basis which the present government actually introduced the concept of insolvency and bankruptcy code, and which has become an extremely popular and a hit a policy reform by the Indian government, and which is being applauded even internationally, right? So in order to capitalize on the stress assets industry, other than the asset reconstruction company, which is introduced by the RBI, SEBI also, on the similar terms and as a corollary, introduced the concept of special situation fund. And what does it do? It allows the fund manager to access stress assets basis certain defined conditions. That's the theory and the concept of a special situation fund. Now, and at the same time, these SSFs can also be assigned an insolvency bankruptcy code, which is continuing with the resolution mechanism, right? So what does it allow? If I've done a pooling of this SSF, then I'm allowed to invest into special situation assets. Special situation assets are nothing but stress assets as defined by RBI, security receipts registered with RBI, borrowings, basis which insolvency resolution codes are in place, or there are defaulting mechanism in terms of interest, repayment of loans, and so on and so forth. Even the payments which are being defaulted on a recurring basis of more than 90 days are covered under SSF, where the SSF can subscribe to these loan as well as stress assets. Interestingly, even where instruments which have suffered a downgrading of credit rating or derated paper will fall under the SSF mechanism or any other asset specified by SEBI. So that's where the SSF fund lies. Now, typically in terms of what are the key attributes of the SSF, so investment restriction. So this has to be a minimum 100 crore fund. It can invest any size and any scale of investors. Similar to what AIF category 1 and 2 is, this is the category 1 license. So you'll have to comply with the sponsor commitment of 2.5% or 5 crores, whichever is less. There's no specific restriction on the investments. Should it be in unlisted, listed, as the case may be. So you can go ahead and make any investments through the SSF per se. And very importantly, unlike a category 1 or 2, where you have an investment concentration limit of 25%, there is no investment concentration limit which have been prescribed for an SSF. And simultaneously, SSF can, however, cannot accept any investment from another SSF, as the case may be. So if it is a fund of fund, which is also a special situation fund, they cannot invest, unlike the previous fund of fund regime that we spoke about. So that's the broad investment criteria, right? Definitely, as I mentioned, any investments that you make into your own affiliate or an associate entity or a group entity is completely restricted or prohibited. What are the administrative guidelines? So again, you will have to make a filing with SEBI within 30 days prior to launch of your scheme. So that has been certainly liberalized to an extent. There is a constant monitoring mechanism of the investments that you've made into these special situation or stress assets. And this has to be complied with a periodic timelines or guidelines as suggested by the RBI. Okay. This investments by SSF in AIF into the special situation assets are subject to the lock-in timelines as prescribed by the RBI. So these are some of the procedural aspects that needs to be complied with. On the similar lines, and this is a popular concept basis, which if you can just try and correlate, was you had a 2008 meltdown in the US, probably one of its kind, where there was an economic slowdown, and basis the credit default swaps as a product, the US market went through a global meltdown per se. So introducing similar such concept in India and through a thorough regulatory mechanism, SEBI has permitted AIFs category 1 and 2 to make investments into these CDSs or credit default swaps, primarily issued by financial institutions or banks. And these are available to these AIFs only for hedging purposes. So for example, if I have a debt product and against that I wish to hedge under a CDS, is something which I can do that. A naked position or an open position under CDS is not permissible. So that's where it has been provided. However, certain relaxation or flexibility has been granted, is where category 2 and 3 can sell CDSs which are earmarked or encumbered against government securities or bonds. They are again debt instruments which have been prescribed, right? Interestingly, for category 3, a CDS investment or an exposure is not regarded as leveraging, because CDS, credit default swaps, by inherent nature is leveraging, but at the case maybe, it is excluded from the leveraging computation when it comes for category 3. Certain reporting mechanisms have been prescribed where there will be periodic reporting in situations of defaults, breaches, as the case may be, that needs to be rectified, and all these mechanisms have to be carried out through an authorized custodian. Interestingly, unhedged positions, or as I mentioned, naked positions in CDS over 25% will require a specific intimation or an approval route from the unit holders as such, right? And necessarily what has been prescribed by SEBI is that all these transactions will have to be run through RBI and SEBI approved platforms only and not otherwise. So that's another product area which is evolving, while SSFs and CDS is something which saw the light of the day sometime, last year itself. Between last year and this year, I think this is yet to evolve and kick off, right? This is very important, and I'll quickly brush upon as to what this is all about. This is an international concept prevalent, introduced sometime last year in India, where you allow accredited investors to participate into a financial services market. Accredited investors are nothing but investors who understand the financial services market extremely well. They are well informed. They understand the products as well as the risks that are associated before investing into these financial services product. Now, as part of accredited investors, while I can qualify myself as an accredited investor, what SEBI did was that they introduced a certification mechanism for the accredited investors. Rather than having a self-certification, they appointed an agency, likes of BSE, you have CDSL as the case may be, who grant you the certificate. There are certain conditions, eligibility criteria to be complied with, to be furnished, and basis which you will receive a accredited certification. Now, quickly, let's understand what are they. So it's only for eligible AIs who satisfy income and net worth criteria and financial service, financial asset. Unfortunately, financial asset is not defined. But having said so, it's only those kind of category of investors who meet these criteria will be able to grant these AI statuses. Who are they? It could be individuals, HUF, family trust, sole proprietorship, and so on and so forth. And looking at what are the conditions, you have to have an annual income of at least more than 2 crores, or you should have a net worth of 7.5 crores, of which 50% should be in financial asset. Or you can have a combination of both, annual income more than 1 crore and net worth of more than 5 crores, of which financial asset is more than 2.5 crores. So that's the condition that needs to be satisfied. Only basis the satisfaction of these primary conditions, where you will be granted an AI status. Now, there are certain caveats or restrictions, is where your residential premises cannot be included for net worth computation. It's only the overall financial assets which will be considered. Secondly, a joint application can also be made between you and your children and so on and so forth, provided they meet the independently meet the eligibility criteria. And you can make it along with your spouse, where combined as well as independently, on a combined basis, they meet the eligibility criteria. It's only for the spouse and not for the others. Okay. Similar concept introduced for trusts as well as body corporates. Here, the variation is that the net worth should be more than 50 crores and the net worth is defined, which includes book value of the tangible assets. So intangible excluded minus the book value of your liability. Similarly, you have for body corporates where you have capital plus reserve minus the accumulated losses plus deferred expenditure. Same principle or definition as that of Companies Act, right? Body corporates and trusts who are eligible for an AI will be granted the status basis their statutory audit report. And these statutory audit report has to be signed as on that particular date when it is being issued. Okay. For partnership and the LLPs, as the case may be, the partners or the designated director, partners as the case may be, should meet the eligibility criteria to avail of this particular benefit. Otherwise, it is not available. And simultaneously, this concept of AI is also available for foreign investors. This will be basis their offshore information converted into INR equivalent to grant the status basis the eligibility criteria, right? So what are the benefits? Why will you want to do it? And what are the key attributes? In quick nutshell, the key benefits are that today, if I have to, as an investor, I have to make a 1 crore of investment. For a AI status owned investor, you can have a lesser threshold also. So I can make investment into an AIF for even 10 lakhs. That's the respite that is available, right? The second thing is in terms of AI related filings that needs to be made of the offer document with the regulator. That has been significantly relaxed. Okay. So the 30 days window is not available and prevalent. Then you have an extension of 2 years. Now it can go beyond also of extension of 2 years when it comes to the tenure of the fund. So for standard investors, it is 2 years. For AI, it can go even 3 years as the case may be. And this is the most important part. So today you have investment concentration limit of say probably, 25% for AIF category 1 or 2 and 10% for AIF category 3, which is enhanced for AIF category 1 and 2. It is 50%. So I can make 2 investment if I am a AI. And similarly for AIF category 3, it is 20%. So in effect, I can make 5 investments if I am a AI investors into that particular fund, right? Similar thresholds have been prescribed for angel funds, and scheme filing can be done even without a merchant bank. So these are some of the benefits that one can look at for AI related AIF. Now let's look at the attributes of the AI. How do you get it? What are the mechanisms? So for AI to qualify into a fund, you need to have a minimum threshold of 70 crores. Anything below that will not qualify as an AI. Okay, so that's part 1. However, for individuals whosoever satisfy the AI status, they will be granted a specific treatment who will have to comply certain specific criteria if it is offered by the AIF per se and not others. Okay. This AI status, which is issued by the regulated agencies like BSE, CDSL as the case may be, is valid for a span of 2 years or can be preponed for 1 year also with an option to renew. Okay. And very importantly, these AI statuses are onboarding of these AI investors is available only after they furnish an AI certification. And this needs to be thoroughly verified by the fund manager before onboarding them because of certain conditions which are available or which are granted to them, which is prescribed into their contractual arrangement. Now, what happens if there is an early stage expiry or ineligibility of satisfying these AI tests? Then there will be a withdrawal of these consents which will be made, and most of the conditions which have been relaxed to these investors, if prior to the expiry they discontinue with that particular AIF, they will have to go back to those particular investment related guidelines which have been prescribed for a normal AIF. So for example, if I made an investment of 25 lakhs because I was an AI and I want to discontinue with a particular AIF, then I, as an AI investor who want to discontinue with a particular investor, with a particular AI, I have to bring in that 75 lakhs of gap because I have to make good that 1 crore of investment. However, if the AI status is lost by virtue of certain scenarios, then in that particular case, you continue to hold that AI investment and you cannot make any fresh investments as a accredited investor. So these are some of the attributes one will have to go through. Finally, we come to a co-investment option. Now, what is a co-investment option? Is where we saw in an unstructured manner, some of these funds were allowing their existing investors to participate in their underlying investee company or portfolio companies. And this was not into the PPM, nowhere it was mentioned. This was allowed or done through a side letter, not even through a PPM. So SEBI realized this, and therefore they devised a particular concept or a theory to say that, look, now under the new AIF regime, I'm allowing AIFs to make co-investments to their existing investor with certain conditions. And what are they? It's only available for category 1 and 2 who are making investment into its investee company. When you make an investment into an investee company, it is again permissible only in unlisted securities. So for listed securities, the co-investment opportunity is not available, right? And the kind of contract that you make as a direct investor into these investee company where the fund is also invested, then it cannot be more favorable to the fund which has made an investment. Okay, so that is a precondition. Simultaneously, if the fund were to exit, then even the co-investor will also have to exit. And very importantly, they clearly suggested that other than the investment manager who is suggesting a co-investment to its investor, you cannot render any advisory services to a third party. So in effect, what it means that if I am not an investor into the fund, then I cannot render any advisory services to anybody for that matter who is making a co-investment into my investment strategy. Okay. Now, all these investment strategies are particularly done to a co-investment mechanism, which is permissible under the portfolio management license. So today, it was earlier done through a side letter, but now what will happen is that the investment manager will have to parallelly also go ahead and make a registration of a portfolio manager under the co-investment model with SEBI. Only then can you render co-investment option. That is part one. Second, if some of the fund manager are already a PMS, okay, then you just have to make an intimation. You don't have to seek any separate registration. So these are some of the key criteria that have been prescribed. These are some of the key developments. I would want to just quickly brush upon some of them are into consultation phase, which I will not talk about. But the most talked about circular by SEBI today is the distribution fee. And what it entails today is that AIF scheme who renders their investment strategy through a distribution mechanism and also pay distribution fee to distributors will necessarily now have to come under through a direct plan. What it effectively means is simply replicating this like a mutual fund. I will give the investor an option to come under a direct plan, or alternatively, they can come through a distributor plan, which is a regular plan. Okay, so that has been prescribed. Now, it is also prescribed that any investor who also pays additional fee to any advisor, or for that matter, PMS, then they also come through a direct plan only, because there is a leakage. There are two-way fees which is being paid. So that has been prevented by allowing them to come through a direct plan, right? And importantly, that these category 1 and 2 funds, when they are making payment of the distribution fee to the distributor, then upfront is available or restricted only to the 1/3 of the commitment of the distribution fee. The balance will be on trail basis. For category 3, everything is on trail basis. So that is a key one that you should be aware of. Excuse and exclusion, they made it more watertight, standardized, and transparent for certain investors who used to carve themselves out from certain investments, which they never used to like. So now it is available only when they furnish a legal or a tax related opinion, followed by, in their investment policy, it is restricted. It has been pre-informed to the AIF. Only then it can be excluded and excused, and not otherwise. So there are certain checks and balances which have been come into play, right? I will not talk about unliquidated investment. It's very complicated, but it simply says that, there are investments which are unliquidated for certain AIFs, and for which extensions are being sought. So now SEBI has come out with a mechanism to suggest that we have a plan, we have a solution. You go ahead and make selling and make an offer either to third parties at whatever rate you want at the prescribed valuation. If not, then you can set up a specific dedicated fund only for these illiquidated investment related activities. So that is very important. Okay, that has been suggested. This is under consultation to be approved. Second, dematerialization of AIF has been introduced. So any AIFs which is exceeding 500 crores ka limit will have to dematerialize the units of these AIF. And they have been granted a timeline up to 31st October 2023. Okay. And then for other AIFs, the timeline is 30th of April 2024. Right. Eligibility for key IM and the compliances, as I mentioned, the compliance officers have been made mandatory to be appointed as far as the AIFs are concerned. Now, besides the eligibility criteria of the compliance officer, of the investment manager, what has been recommended is that you also have to pass an exam. So that is being made mandatory. And then finally, you need to obtain an investor consent of at least 75% of investors by value if you were to make investment in any of the group entities of the fund manager. So that has been also prescribed. With this, I think we broadly cover what an AIF regime conceptually, developments, how do you go about look like. I will start with the other thought process in terms of foreign investment framework in India and the correlation of the AIFs per se. So foreign investment routes in India are primarily in the form of direct investment, portfolio investment, or investment vehicle. Direct investment would be in the form of ODI route, as all of us are aware in terms of JV, LO, LRS, and so on and so forth. Portfolio investment, NRI, PIOs, FPIs, and so on and so forth. And investment vehicle in the form of VCFs, AIFs, REITs, InvITs, and so on and so forth. And this is where we typically will revolve our discussion. Foreign investment guidelines for AIFs, extremely made simple. So today, foreign investments are permitted in the AIF under the automatic route. FPIs are permitted to invest into category 3 AIFs only. And this comes with a subject to 25% corpus of this AIF, which is seeking investment from the FPI. So there are certain restrictions. Other than that, it's been made extremely flexible and liberal. Foreign investors who are holding more than 25% concentration into a particular fund will have to undergo a stringent KYC norm. And they will have to also ensure that they don't come with restricted FATF jurisdiction, or they are not qualified under a grey list area under FATF. Now, category 3 AIFs who are inviting foreign investors will have to necessarily ensure that they invest only in such securities which are permissible for FPIs. So that's a restriction or a criteria that has been prescribed. And with a free offering of units being sold, transferred, pledged, and so on and so forth, no restrictions whatsoever. Control usually has to be in the hand of the sponsor or the fund manager who are Indian resident. The moment the control or the sponsorship is in the hands of foreign entity, which is also permissible. However, this happens to be a regulated financial services market. it falls still under the automatic route. Okay, but as a consequence, it becomes foreign owned and controlled entity, which typically has to comply with the downstream requirement, and which is very simple today, is where you'll have to make a direct investment filing with the RBI, downstream investment filing, right? And any investors participating into such fund will require a filing to be made in form INVI. That's a broad base requirement. Now, conversely, look at a situation where the fund wants to make investment outside of India. Even that is permissible now going forward. However, this is restricted to only under the approval route. So if I have to make an offshore investment as a fund, then it happens under the approval route with SEBI. And then there are certain limits which have been prescribed. So at an overall AIF industry level, there is a $1,500 million limit under which the investments can be made by an AIF. So in effect, if the $1,500 million limit is exhausted for the year, then I, who want to make an investment outside, will not get that limit this year. Then it will go to the next year, right? There's an investment concentration norm, as we discussed, for category 1 and 2, which is 25% of the investable fund, beyond which I cannot make investment outside of India. And necessarily, this is permissible only for category 1 and 2 only. So category 3 AIF cannot make investment outside of India. Importantly, any investments which is made by an AIF outside of India particularly has to be in those countries where the securities market regulator have signed an MOU with India and not otherwise, and they don't feature into the grey list of FATF. Okay, there is a permissibility of making reinvestment of sale proceeds, liquidation, redemption without any restriction. Once the approval is granted from SEBI, within 6 months, you will have to make an investment outside of India, right? So that's a criteria. And for this, you don't have to access the ODI guidelines because it happens under the approval route of SEBI. All these mechanisms are now being monitored online through online filing. So there is no physical filing that is typically required. Okay. And sale essentially has to be done only to eligible participants as prescribed by RBI. That's what on the offshore investment side is concerned. I'll briefly touch upon the ODI regulation, which got introduced sometime last year in August 2022. So what ODI typically talks about, that 4 times the net worth is something which I can make. If it is a non-financial services entity, then earlier I was not allowed to make investment into a financial services entity, but now I can make that. But for that, I don't even have to meet any profitable track record. So if earlier the condition was that if I don't have 3-year profitable track record, I cannot make investment into financial product. Now that has been done away with. Financial services entity is strictly still under the approval route of the financial services regulator. I will have to conduct a profitability test before, or of the 3-year track record before I make investment outside of India. And I will have to seek approval from the regulator within 45 days. Otherwise, it gets lapsed. I can't make it, then I'll have to reapply. Okay. Now, this is under the structural ODI route. ODI route is where typically I have investments more than 10% and is construed within control theory, right? If I have control into a particular equity, it is ODI. The moment I make portfolio investment, which is less than 10%, okay, is fall under the OPI or it is overseas portfolio investment. Here is where I have to maintain a net worth of 50%. Okay, if I do not have a net worth of 50%, only to that extent I can make investment into an OPI, otherwise I cannot. So that's a condition. As an Indian entity, I can make investment into a gift city or a IFSC kind of a structure also, which is extremely popular and promoted by the present Prime Minister Narendra Bhai Modi. right? So it is now permitted in any of these structured products without any restriction, right? As a resident individual, I cannot use an ODI, I cannot use an OPI, I use an LRS route. And under LRS route, I have a $250,000 limit, which can be remitted either in GIFT City or structured products as the case may be. So no restrictions at this point of time up to that limit. However, one will have to suffer TCS of 5% at this point of time. And that is proposed to be increased post-July to the extent of 20%. So that is under strong monitoring, that any money which is going outside of India needs to be strongly monitored. So this is an overview as to what offshore investment is looking like today. And this was important for me to, let you know the subsequent discussions of taxability now going forward, right? So now we come to tax of AIF category 1 and 2. Extremely simple, made simplified after 10 good long years. Simple structure, you have investee company giving money to the AIF 1 or 2 and then ultimately it going to the investor. Taxable in the hands of the AIF. 1 and 2 is a pass-through. Pass-through essentially mean it is taxed directly as if it was invested by the investor into the investee company. So there is no blocker entity. AIF 1 and 2, which is a trust, will not have to pay any tax. Directly it will go in the hands of the investor, as if it was made directly by the investor, right? It is only subject to a TDS of 10%. So for non-resident, you can go back to the tax treaty. Otherwise, it is subject to 10% TDS. And that is also creditable in the hands of the investor. Okay. There is no withholding or no TDS done by the investee company to the AIF category 1 or 2 fund. So there are no leakages, right? And remittance formalities, if it is a non-investor, non-resident, then you'll have to comply with 15 CA, CB, and so on and so forth. Okay. Deemed income distribution is prescribed. So for example, what it says is that AIF category 1 and 2 does not make a factual distribution or does not make a cash flow distribution to its investor. At the end of the year, any money which is distributed by the investee or the portfolio company to the fund is regarded as deemed distribution and which will attract a 10% TDS to be paid for and on behalf of the investor. Now, whether investor shows it as an income or not, doesn't matter. TDS has to be deducted. So that is part 1. Second, in the hands of the investor, tax on investor in the same and like manner and in the same proportion as if I'm holding into the fund. So that's very simple. Business income will be taxed at MMR or the highest rate of tax, and any upstreaming of income by the fund to the investor is further not taxable. So if other income is taxed by the fund in the hands of the fund at 30%, then any distribution thereof in the hand of the investor is not taxable. So that's tax exempt because it has suffered tax once, right? It is treated, as I mentioned, tax directly as if I have made an investment. But for non-resident, there is a specific clause that if the income is exempt and the tax is not to be paid for the non-resident, then I need not have to file tax return also in India. Or there need not be any TDS also here in India. So that's a clear respite which has been provided. Okay. Of course, a tax credit can be claimed of the TDS which has been deducted by the fund. Okay. I will not talk about pitfalls except for one, that there can be a mismatch of the income versus the TDS done in case of deemed distribution treated by the fund. So today I will treat it as a deemed income in the hand of the investor. The investor, if it is an individual, it will not offer it to tax because it is following a cash system of accounting. And therefore, there is a mismatch. And in near future, if the income which is accrued in the hands of the fund, but not received, then that will attract a tax leakage. So that requires a little bit of planning. Okay. What are the trends, pitfalls? Income characterization, which anyways is prevalent for investor in India, but to a larger extent that has been resolved for category 1 and 2. It is always investment income, so capital gains. There are no challenges, right? In case of non-applicability of withholding, you may have to reach out to the tax authorities for availing of a lower withholding tax certificate. So that's a respite that is available. I will not get into trust taxation, because if you don't have a category 1 or 2, and if you are a category 3, then you will have to follow trust taxation principle. And trust taxation principle, I'm sure most of us are conversant, that if it is a revocable tax, if it is a revocable trust and a determinate trust, then it has to be treated as transparent, and the distribution will be treated in the same and like manner as that of a investment which is being made by the trust. So that's a concept. I think I can leave that to you for a bedtime reading. Okay. So it will follow the same theory as that of tax pass-through, if you follow the determinate and the revocable trust principles. However, this has to be evaluated on a case-to-case principle basis, and which is where it pegs to category 3. In absence of category 3 having a tax pass-through status, you may have to go to the trust taxation principle basis the interpretation of determinate and a revocable trust taxation to claim this trust tax pass-through status. That's the only point that I wanted to draw. Here, in taxability in the hands of the fund, there is no TDS which is applicable, except for the fund which will have to pay tax at the basic rate or basis the income that is being derived, like capital gains 10, 15, 20 or 15 as the case may be, and which will be distributed to the investor. Now, to the investor, as in when you distribute, after deduction of the tax, because I'm a blocker entity, nothing becomes taxable in the hands of the investor. However, it works on a particular theory that the fund has paid the tax. If the fund has not paid the tax, then there can be a litigative position. However, since last 40 years under the trust taxation principle, there have been no litigation. So I think one can rely on that particular theory amply. If one were to get a more reasonable certainty, then one can look at obtaining a lower withholding tax certificate from the tax authority. So that is something for a reasonable certainty one can look at. Common problem of having deductibility of expenses, including leverage or borrowing. What can be done out here is you can claim this interest if you have business income, which is derived from the fund, which you offer it to tax, and not otherwise, and which is taxable in the hands of the investor. So if nothing is taxable in the hands of the investor as business income, then then the expenses like management fee and so on and so forth, including the interest, is a sunk cost. Okay. This is more of an international concept where, a safe harbor rule for the investment manager was detected by the income tax authority. And what was prescribed is that by some of the fund managers sitting here in India, they are managing global fund. So this attributes a taxable presence of that fund in India, or a PE risk in India, in short. Okay. So what tax authorities devised a theory was a safe harbor rule. They clearly said that, look, if you as a fund manager render certain advice to a global fund sitting here in India and satisfy certain condition, okay, then you will not constitute a PE in India. And why is the risk? Because today we have a risk of substance versus principal purpose test, which is prevalent under the tax treaty. You've got significant economic presence test. You've got place of effective management and CFC rules. You've got P risk anyways under the tax treaty. You have, as a result, you will have a tax on profit attribution, which is derived by the Indian fund manager, but earned by the fund in India. So there will be an imputation of such income derived by the fund in India at a higher rate of 40%. Okay. And then you have got multi-advisor structures and so on and so forth. So in order to mitigate all this, tax authorities in 2016 introduced a concept of safe harbor rule. They clearly said, if Indian fund manager are doing this, you satisfy the condition, obtain a certificate from CBDT, and then you're absolved from that liability. There is no tax risk for the fund to whom you're advising sitting here in India. Simple. That's the concept. Okay. Now, I won't get into too much of conditionality, but I'll just briefly brush upon. So there are two-pronged approach that needs to be satisfied. One, at the onshore fund manager approach. So if I'm an Indian fund manager and I'm rendering these services, I need to satisfy certain conditions. What are they? I need to be an eligible fund manager. Second is I should not have any employee which is connected with the fund. There is the compensation is restricted to 20% of the profits of that fund. So that's at an arm's length principle, right? Then there is no affiliate or associate or group entity connected with that fund. And then I make a periodic reporting. That's one of the conditions. There's a condition for the offshore fund also, where there has to be a basic KYC that needs to be met at the fund level. They come from 90 plus jurisdiction where India has got a tax treaty and they are not under the grey list of FATF. Second, you should have at least 25 investors in that particular fund, of which 5% should be only Indian. So, and at an overall level connected person to that Indian resident, not more than 10%. So, clamping of Indian investors to go global. Okay. Fund size should be greater than 1 billion, 100 crores. Right. Investment concentration limit in associate or affiliate entities prescribed. Activities, no business activities in India should be there or discovered. Okay. And remuneration have been prescribed for certain categories. Only if you satisfy cumulatively all these conditions, I will give you a certificate where you will not, as an Indian fund manager, constitute a P of the offshore entity which you are managing or advising in India. Okay. There are certain remuneration criteria which I'm not getting into nitty-gritties, but these are restricting the ability of the Indian fund managers to manage global funds, which is category 1.5% of 0.1% of the AUM. And then there are other optionalities. This comes with specific filings here in India. Okay. Now, taxability of the eligible fund manager remains the same as that of normal fund manager. Any income which is received from the global fund by the investment fund, by the investment manager here in India will be subject to their local TDS. And when you offer it to offer that income here in India, there is no, you can claim the tax credit. So that is part one. Secondly, there is no income attribution of that fund here back in India. And there's a clear theory of claiming no GST on such income because it will qualify for export of services as such. Other than that, there are operational guidelines that needs to be followed. Again, I think I've got 15 minutes. So this is as at best I can touch upon in terms of this particular subject matter. What are the key considerations? There is enough diversification for AMC entities to sit here and advise global funds. Specific exemption for category 1 is available. Relative certainty of tax is available for these fund managers when they are rendering multiple services. Choice of legal entities. You can be a company, LLP as the case may be. Minimal impact of GAR. So today, if I don't do this, I don't obtain a CBDT certificate, I am subject to GAR. By obtaining a CBDT certificate, there is no anti-abuse provision. Stringent conditions have been to an extent liberalized, but not completely. The downside is CBDT does not give you approvals easily. Conditions still remain very complex and cumulative to be satisfied. Operating and indirect cost remains to be reasonably high. So these are some of the downsides. I won't touch upon the key budget areas. This is one concept that I wanted to, probably help you understand. To achieve, if I were to make an investment into a listed product, that is available only to the extent of 49%, right? Because primarily it has to be done in unlisted. Now, if I want to derive further income from listed products per se, okay, then what can be done is that you create a layered structure of unlisted LLP and then conduct a listed activity of F&O. Now, what will it help you achieve is the F&O income or futures and options income, derivatives income, will not take the color of derivatives income, which is taxed at the highest rate of 30%. Followed by under category 3, if I were to do this, simply derivatives and listed, then I run a risk of the normal income to also be characterized as business income and can be taxed at highest rate of 30%. Now, by doing this, I achieve two objectives. One, I can have pass-through status and at the same time have higher allocation of investment to listed. And at the same time, I don't run any risk of being taxed at a maximum marginal rate at the fund level. So that's a cute solution that is available that can be looked at and explored, right? Pooling option, this has been to an extent marginalized because in last year's budget, this year's budget, the overall effective tax rate is 39%. However, it was 42% earlier. Now, having said so, what has happened is, if I have to structure my pooling vehicle as an LLP, then I pay tax at the rate of 35% instead of 39%. So that's a clear respite that is available. So effective tax rate, you can still save 4%, effectively in terms of by establishing a pooling vehicle as an LLP and not as a trust. And it has its own pros and cons, but I'm not getting it. Last leg of the conversation, part B. Very briefly, I will touch upon the IFSC, particularly when I'm promoting an AIF and Gift City. So this is an evolution of what Gift City is looking like. In nutshell, a Gift City or an IFSC in India, which is prevalent in Gujarat, is nothing but a Mauritius or a Singapore in India with similar set of benefits, relaxations, tax benefits, and so on and so forth. And this got evolved since 2015, where it was first time featured by Finance Minister, got evolved, pet project of the Prime Minister now, found its feature in multiple budgets. And when we look as on 2022, last year, the latest was that fund management entity regime, where you will be able to set up an AIF is permissible. And it's a full-blown financial services ecosystem where you will be able to establish your financial services activities to undertake global as well as domestic Indian activities. So that's the clear advantage. And particularly, you can set up your AIF category 1, 2, and 3 as the case may be. Who are the eligible participants? You have stockbroker, merchant banker, trustee, registrar, investment agent, investment advisor, depository, stock exchanges, AIFs and mutual funds. All of them are encompassed in that jurisdiction, right? These are some of the products that are available. I won't touch upon that. You can go down the GIFT IFSC website and have a look at it. In nutshell, what are the benefits? I'll just walk you through. It's an SEZ zone dedicated for financial services. You have a possibility of institution banks, capital markets, insurance, all are SEZ registered. Okay. Relaxations, there is no CSR. Resident directors mandatorily can be there only for 1 year. Rest you don't have to be there. Okay. There are no approvals required in terms of preparing your cash, your annual statements, cash flows, while Index is available, but you can align them with your financial year, right? And so on and so forth. Importantly, what does tax have to offer? Income tax, 100% rebate for the legal entity, 10 out of 15 years. So initially, if you have lost, no problem. Post that, you can start claiming once you have profits after adjusting your losses. Okay. Debatable theory, MAT and AMT is prevalent, but for a legal unit, it is not applicable if you fall under the new regime. Okay. For the units, there's no GST. Any capital goods that have been bought in that particular jurisdiction, again, you don't have to pay GST. Okay. And then there are other subsidies which the governments grant you. For the investor, tax-free money, which is available because the fund does not have to pay tax on the activities, including investments which are being made in India. Okay. There are certain listed products available, prevalent in GIFT City, which will attract lower or zero tax. So that's a clear advantage. Again, no GST, no incidental taxes in the form of STT, CTT as the case. So that's a clear advantage. Okay. Let's quickly jump on to the fund management entity regime, which is prevalent in GIFT City. So it's a dedicated fund management entity now available for AIFs to be set up in GIFT City. Now, what can be done is they are typically bifurcated in three parts: authorized fund management entity, registered fund management entity for non-retail, and registered fund management entity for retail, which is nothing but mutual fund kind of setups. And then there are other fund management activities which are governed under FME regime, which is PMS, investment trust, family investment trust, and so on and so forth. Okay. And what are the categories which will get governed under these funds? Primarily registered FME, non-retail are VC fund, AIFs, SSFs, exchange traded funds, and so on and so forth. Right. So this is a dedicated fund management entity regime, which is replicated from Singapore. What it says is that if the fund management entity is regulated, then the fund need not be regulated. I need only one entity to obtain a license from SEBI or IFSCA, which is the International Financial Services Authority in GIFT City. That's one license to be obtained, no other license required. Then subsequent filings to be done. That's all. So that's the simplistic regime which is available today, right? Investment structure almost similar. You have a fund in GIFT City where the licensed entity is FME, and then that floats a fund in GIFT City, and you derive investors either from India or from globally. Preferably, the AIF regime in IFSA requires global investors. Otherwise, tax benefits are not available, right? Key pointers: investment concentration does not apply, and simultaneously you can do as much leverage as you want in your global fund. So instead of category 3, which is twice the NAV, here there is no restriction. Quickly, what are the kind of conditions that needs to be satisfied is that you can have a person resident in outside India to invest in this fund, which is NRI. You can have institution investor, you can have an Indian resident investor. And what are the precondition? Minimum net worth of $500,000 as a sponsor commitment net worth. And the net worth, if provided into the company, then that can also take care of the sponsor commitment. So that's there's a double counting. Second, minimum 2% compliance and the investment management profession. Minimum corpus $5 million, and with a similar sponsor commitment of 2.5% and 5% as the case may be. Okay. Investment by investors $150,000 and $40,000 for employees. This is equivalent, if you convert it in INR terms, same as 1 crore and 25 lakhs. Interestingly, green channel. So once I have made a filing with IFSCA of my scheme, then I can start marketing and start getting money from the investor. I need not wait till the time IFSCA gives me an approval. So that's a quick respect. These are the foreign investment routes that can be made. So an AIF in GIFT City can make investment in US, in GIFT City products which are listed in GIFT City, and in India. So 3-way option to make investment in by a AIF in GIFT City. Okay. Investment, similar concept, which is not available in India. You don't have a family office trusts which can be made under the AIF regime of SEBI, that is convergently available in GIFT City. It comes with certain conditions, so it can be established as a company, LLP trust. It has to be self-managed family office. So it has to have family related who can set up this family investment fund. You cannot have outsiders setting up this particular fund. Okay, that's one of the conditions. And however, what they have prescribed is professionals like employees or directors, to the extent of 20%, we are still allowing them economic participation. Beneficiaries still remain the family members, but economic participation can be granted. Anything exceeding that is not permissible. No net worth criteria. However, minimum corpus of 10 million prescribed to be maintained for 3 years. It can be open-ended, closed-ended, no problem. Other operating guidelines will apply. Only one variation other than funds which are in GIFT City is that a family investment fund can also make investment in physical assets. So a family investment fund can buy real assets, bullion, they can buy art, facts, anything. So that is a quick respite. Question to the committee members, do we have time or can I continue for next 10 odd minutes? Is that okay?
So we don't have any questions, so you can continue for sure.
I'll just take 10 minutes, brush up very quickly, and then we can take these questions offline.
Okay. Thank you.
Sorry, quick understanding of the taxability of the fund management entity and the scheme. Okay, a diagrammatic review of how it will be taxed. I'm an investor investing into a GIFT City fund and then making ultimate investments, say for example, in India. Okay, with all these variations, long-term taxed at 10%, unlisted possibly at 20%, debt instrument possibly 0. I can that is what has been prescribed under the IFSC regime. Okay, and futures and options, I can equally take a position of 0. Right, short term it can be 15% or 30% in specific situations only, not otherwise, because there has been an amendment in this budget where MLDs, if invested, are regarded as deemed short-term capital. Simultaneously, mutual funds, which are non-equity oriented, are deemed considered as short-term. So there, subject to that, one can always argue that this is subject to 0 tax, but however, tax authorities may take a other view. Okay, income from foreign or IFSC securities. So any investment which is being made by the AIF in GIFT City in foreign jurisdiction or in GIFT City securities is not subject to tax in India. Foreign securities, while there can be TDS subject to the foreign jurisdiction in GIFT City, other than that, there is no tax because the income does not accrue or arise in India. Right? Dividend tax at 10%, interest 4%, 5%, or 10%, as the case may be. 4% for listed securities in GIFT City. Other than that, one can avail of the 5% or a 10% benefit. Fund management entity, as I mentioned, flat tax holiday of 10 years, 10 consecutive years in 15 years. No MAT applicability. Dividend received in the hands of the Indian shareholder would be fully taxable, because now it is attracting 30% tax. Earlier it was taxed at 50%, which is 15%. Now it is 30% tax. DTA benefits all across available. The investors of the AIF in GIFT City do not have to take a PAN in India, and they don't have to file tax returns in India. So that's a clear respite, and that has been accepted. Okay, no GST, no withholding, no PAN. These are all the kind of benefits that are available, right? I think this is something which we discussed. We can skip now. This is very important, just to give you a bird's eye view in terms of what all things are prevalent vis-a-vis a comparative chart against IFSC and other countries. This is very important. So if I were to look at Mauritius, Singapore, Hong Kong, Netherlands, and GIFT City, it is set up in Mauritius with FSC, Singapore MAS, SFC in Hong Kong, Netherlands AFM, and in GIFT City it is with IFSCA, governed by RBI and SEBI. Okay, regulated mechanism. It is established in Mauritius, matured in Singapore. You will see established in Netherlands and Hong Kong, and emerging and evolving in GIFT City. Specified regime across all jurisdictions. Look at the headline tax rate. It is taxed at 20, 15, 17, 16 and a half, 25%. These are the corporate tax rate of these countries, which again for IFSC, if I'm looking at an FME entity, I'm taxed at 25%. But because of an exemption, I don't pay tax. So that's the headline tax rate. That's what I mentioned. Incentive across the board available for everyone, including GST. Treaty network, GIFT City, 96, because India has got 96, 100 plus tax treaties with countries. Okay. Legal form, I can set it up as trust LLP company. So is any other country. Compliance, we've got minimal compliance. Netherlands has got highest rate of compliance, and still people don't want to come to India. So that is something, is an eye-opener. Fund administration, it can be in-house, it can be limited, or can be outsourced to a third party. Infrastructure is emerging. Again, it is a low-cost jurisdiction at this point of time. Indicative timelines to set up these entities are relatively medium, unlike Mauritius or a Singapore, which is on a fast track. And then cost of setup of a GIFT City entity is relatively moderate as compared to European countries, which is high in nature. This is again a comparison that I've drawn. So when you look at these prominent countries like Mauritius and Singapore, IFSC is just sitting with one downside, is that there is a sponsor commitment. While other countries have got higher amount of cost, setup cost, we just have a sponsor commitment. We don't have a higher amount of cost because everything is situated in Gujarat and GIFT City, which is low on cost, right? In terms of segregation, yes, there is a slightly disadvantage as compared to Mauritius and Singapore. Segregation of asset liability is not available, which is proposed through a variable capital company structure. Not prevalent now, but there's a consultation paper. Once formalized, even this disadvantage will go away, right? So if you look at other aspects, IFSC clearly stands at an advantage, be it cost, timelines, substance, tax, followed by leverage, proximity, easy proximity in India. You don't have to travel down to Singapore and make expenses, right? So that's a clear advantage. Again, a treaty-related summary. I don't want to discuss that. I think that can be shared with you. Yeah, this is very important. Why is it at a sweet spot? Okay, what are the advantages? So it permits multiple investment. I can invest in India, GIFT City product, and globally. Incentive for global fund managers to come back to India. They don't have to be situated outside of India. There's a relative low risk of GAR, MLI round tripping. Round tripping is anyways gone away because of the new ODI regime. Lower threshold of substance can be met. So cost is effectively lower, right? Possibility of offshore leveraging without any restriction. That's an advantage. And there is no investment diversification now when you come to a GIFT City. So that's again a clear advantage. Some key consideration one will have to look at. So migration of existing offshore, onshore entities. So if I'm an entity in India, I want to migrate to GIFT City, that is not permissible. Indirect share transfer provisions still prevail. Listing of AIF is approved by the exchanges, but not implemented yet. Liquidity of GIFT City products is limited at this point of time. Withholding tax can be managed to a larger extent. there's a significant dilution of sponsor commitment, which has been done now because of net worth, same overlapping and so on and so forth. But if a request can be made to the regulators going forward in future, that can be further diluted. And permitting NRIs to invest into India, especially through a FPI mechanism, that can be looked at. So these are some of the key considerations. Some budget respites, I think most of us are aware. This is the process that you have to go through. So incorporating a legal entity, taking an office, developer will give you an PLOA, making an application with SEZ, application to IFSC authority for your legal entity, SEZ authority to issue final letter, finalization of your space, obtaining an approval and starting your registration and activities. This is a clear opportunity for professionals like us. This is what we can help. And this is what the scope of services of an AIF looks like, whether it is Gift City or otherwise. Investment philosophy and assessment is something which is done by us. High level AIF structure and implications will be disseminated to the fund manager. Engage in offshore pooling vehicles for investors. So if you have offshore investors to participate for your investors, is where we can engage. Cost estimate, we can provide indicative timelines and so on and so forth. We can help fund managers prepare preliminary framework or paperwork like contribution agreement, PPM, setting up of an entity, routine compliance, stewardship code, so on and so forth. Post-establishment operational expenses, services like return filing and so on and so forth for fund, for FIU, for the entity LEI code. There are multiple opportunities that are available, including certification. And then advisory and investment sourcing. So if some of the chartered accountants are investment managers or they are investment professionals, they can also showcase transactions to these funds. So that also opens up doors of opportunities for us, right? Simply, I think it's more of a detailed version. So pre-establishment, we get involved in conceptualization and structuring, implementation, setting up, registration of these documents, setting up of these entities. Post-establishment, preparation of the framework, annual maintenance of these entities, filings, and so on and so forth, and then followed by certification. These are all timeline driven. I think a lot of lawyers have captured this market. I think it's now time for chartered accountants to pick this up. Okay. I think this is something which I already discussed. How do you go about live? Documentation. What are the documentations that are involved? You've got article, memorandum, trust deed. You've got investment objective, target investors, proposed corpus. These are the concept discussions which will be made with the fund manager. Sponsor, you need to assess whether they are fit and proper. Do they have any red flags? Otherwise, SEBI will reject their licenses. You need to assess whether these fund managers satisfy these criteria or not. So this is a level of assessment that can be done, and then probably make an application with SEBI, right? This is a broad-based waterfall mechanism, how it looks like, okay? I can share this with you, and it's not very difficult to understand in terms of how the distribution of income flow to the investor, okay? So with profit, it remains in the first column. If I were to look at 100 invested and there is no appreciation, there is a hurdle rate of 10. There is no distribution which is going to the investor. With a hurdle rate, if there is an investment of 100 and there is a 110 with appreciation, there is a hurdle rate of 10 which is being made to directly pass on everything to the investor. The fund manager does not get anything. Okay. And now comes the carry and catch up. If I have made super profits on the investment for the investor, so it is 100. The investment with appreciation is 150. The hurdle rate is 10. So effectively, the incremental is made 140. And basis the contractual arrangement, there will be a catch up. So 140 minus 110, which is the hurdle rate, 100 plus 10. So 110. Of that, I will make 25%. So that's a clear distribution that can be made because it's over and above. I make as an investment manager, he makes 7.5. Okay. Now additionally the performance fee or the bonus that I will be able to enjoy. It's a 80-20 model. 80 goes to the investor and 20% comes to me. So of that, 30, which is the incremental, minus 7.5, which is something which I've already received. Of this 22.5, I additionally make 20%. That is my share of the additional super profits. So which is 4.5. So in effect, the investment manager makes 12 and the balance 38 is being shared with the investor. Simple calculation, it can get as much complicated as you want, right? Registration process has become extremely online. By paying off the fee, uploading the PPN, we can start the registration process, and which goes to the regulator. It typically takes 3 to 4 months to obtain this particular license. Okay, these are some of the fee charts which is readily available on the website of SEBI. AIF category 1, we have it. This is in millions, so you pay 5 lakhs, 2 10 lakhs, 3 15 lakhs, and angel fund 2 lakhs. Right? So these are the effective costs. These are some of the asks, and these are some of the value-added propositions. With this, I will just simply end the session. So you've got deal sourcing that can be done. Performance and carry structure is extremely important for the investors as well as the fund managers. Thought leadership and training, fund management activity and certification, which includes policy framework, cross-border integration and transaction, and diagnostic review of the funds per se, if they are existing in nature. So these are some of the professional attributes that can be made, and which is where we can, as a professional, make our set of money. With this, I think I've already overshot my timelines, and with this, I close my session for the day. Thank you.
Thank you so much, sir, for sharing your valuable knowledge and information with us. So we are not having any questions, so we will conclude the session here. And it was indeed a very in-depth and informative session. And I want to thank you on behalf of Committee of Financial Market and Investor Protection. Lastly, I want to thank our chairman and vice chairman of the committee for organizing such needed webinar. Thank you so much, our audience also.
Thank you so much.